Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're jumping into the mind of an absolute legend, Benjamin Graham. You probably know him as the father of value investing, and for good reason. His ideas have been the bedrock for some of the most successful investors ever. So let's get right into it and break down his core principles. All right, so let's start with a big one. Is the stock market basically just a giant high-stakes casino? You know, a chaotic mess driven by pure chance, gut feelings, and a ton of speculation. And look, for a lot of people, it really does feel that way. But Benjamin Graham, he saw something completely different. He believed that underneath all that noise and chaos, there was a logic, a discipline, a way to turn that chaos into a real opportunity. So to get inside his head, we have to start where he did, by drawing a very, very sharp line between two totally different ways of operating. On one side, you've got the speculator. They're obsessed with the flickering price on the screen, riding the waves of market sentiment, and always chasing that quick buck. But on the other side, you have the investor. The investor tunes out the hype. They focus on just one thing. What is this actual business worth? They're in it for the long haul, driven by patient, disciplined research. Okay, so Graham's whole philosophy really rests on three massive pillars. And the first one, the very foundation of everything, is all about learning to see what most people miss. Figuring out what a business is actually worth, completely separate from its day-to-day stock price. This brings us to the core concept of intrinsic value. Now, this isn't some magical, unknowable number. It's a real, calculated value you arrive at by doing your homework. It means looking at the hard facts, the company's assets, its earnings, its potential for future growth. Think of it like this. It's the price you'd be willing to pay if you were buying the entire company, not just a tiny piece of it. The stock price can swing wildly based on news and emotion, but the intrinsic value is anchored in business reality. So how in the world do you actually find that number? Well, it's not as simple as punching a few things into a calculator. It's really a mix of art and science. The science part is digging into the numbers, poring over those financial statements, really understanding the assets and the cash flow. But the art is just as important. That's your judgment call on things like, how good is the management team? Does this company have a real, durable advantage over its competitors? It takes a ton of patience and discipline to do it right. Okay, let's move on to pillar number 2, because knowing what a business is worth, well, that's only half the battle. The next step is this beautifully simple but incredibly powerful principle for protecting yourself from the one thing you can never really predict, the future. Graham called it the margin of safety, and the idea is just brilliant in its simplicity. You never, ever pay full price. Why? Because the future is uncertain. You might make a mistake in your calculations. The economy could hit a rough patch. So, by buying a stock for significantly less than what you've calculated it's worth, you build yourself a buffer. It's a financial cushion that protects you from bad luck or, frankly, from your own mistakes. Let's make this really concrete. Say you've done all the work, you've gone through the financials, you've assessed the business, and you've confidently calculated that the intrinsic value of one share of this company is exactly $1. Now, here's the key. The margin of safety principle says you don't buy it at $1. You don't even buy it at 95 cents. You patiently wait until you can buy that $1 of real value for, say, 65 cents. That 35-cent gap, that is your protection. That is your margin of safety. And listen, Graham himself said it best. This idea wasn't just some clever tactic. For him, it was the absolute cornerstone of his entire philosophy. He believed that the ultimate way to manage risk wasn't some complex financial engineering. It was all about the price you pay. If you pay a low enough price, you give yourself a massive, massive advantage right from the start. And that brings us to the final pillar. Now, this one isn't a calculation or a formula. It's a mindset. And Graham explained it best through this wonderful little story, an allegory about your very emotional and very unpredictable business partner. Graham asks you to imagine that you're in business with a guy named Mr. Market. Every single day, he comes to you and he quotes you a price. It's the price he's willing to pay to buy you out, or the price at which he'll sell you his share of the business. Every single day. The thing about Mr. Market is, well, he's got some serious mood swings. On his good days, he is wildly euphoric. He only sees blue skies ahead. And driven by pure greed, he'll offer you crazy high prices for your shares, prices that have no connection to the company's real value. You can see his euphoria everywhere today, amplified by cable news and social media hype. But then there are the bad days. On those days, he's completely consumed by fear and pessimism. All he sees is doom and gloom. Maybe he read a bad headline or saw a negative tweet. Whatever it is, he's panicked and desperate to sell, and he'll offer you his shares for pennies on the dollar, at a fraction of what they're truly worth. So here is Graham's million-dollar question. As the sane, intelligent partner in this business, would you ever let this guy's daily emotional roller coaster dictate what you think the business is worth? Of course not. In fact, his irrational behavior isn't a problem. It's an opportunity. It's a gift. And this is the punchline. Mr. Market is there to serve you, not to guide you. You have to remember that. When he shows up euphoric and offers you a silly price, you can happily sell to him. When he's panicked and offers you a bargain, you can gladly buy from him. And on all the other days, you just ignore him. You stick to your own analysis, your own homework on intrinsic value and margin of safety to decide when to act. You use his madness to your advantage. So when you put all of that together, intrinsic value, margin of safety, and treating the market as your servant, you get an incredibly powerful logical philosophy. And it's no surprise that these ideas didn't just stay tucked away in a textbook. They went on to have a profound, lasting impact on some of the greatest financial minds in history. I mean, you can literally trace the chain of influence. Graham writes his two masterpieces, Security Analysis and The Intelligent Investor. He then becomes a professor at Columbia University. And who shows up in his class one day? A young man who had read his book and basically moved across the country just to learn directly from the master, a guy named Warren Buffett. And look, Buffett has never been shy about this. He calls The Intelligent Investor the best book on the subject ever written, period. He's said over and over again that Graham's framework is the foundation that his entire legendary career was built on. Buffett's incredible success is probably the single most powerful case study for just how effective Graham's ideas really are. So why have these ideas lasted so long? It's because they're timeless. They're not about predicting the next hot stock or trying to guess which way the market will zigzag tomorrow. No, they're rooted in simple business logic. Buy good companies for less than they're worth. They give you a real framework for managing risk by demanding that margin of safety. And crucially, they tackled the biggest enemy for most investors, their own emotions, which Graham so brilliantly captured with his Mr. Market story. And because of all that, these principles work, whether the economy is booming or busting. They empower you to think for yourself and trust your own research, not the noise of the crowd. Which really leaves us with this one last thought. We live in a world that is just drowning in data. We've got instant information, high-frequency trading, news alerts hitting our phones every second. But maybe, just maybe, Graham's greatest lesson is that the ultimate advantage doesn't come from having faster computers or more data. Maybe the real advantage comes from having the wisdom, the patience, and the discipline to focus only on what truly matters. All right, let's talk about a guy who looked at the absolute mess of this stock market and thought, you know what? There has to be a smarter way to do this. He decided to create a logical blueprint for success, and his name was Benjamin Graham. I mean, that's the real question, isn't it? When you see the market bouncing up and down like a yo-yo, you have to wonder, is this whole thing just a giant casino? Is it all just dumb luck? Or is there some kind of underlying logic, a system you can use to actually win in the long run? Well, that's exactly the puzzle Benjamin Graham was determined to solve. Because let's be honest, for most of us, investing feels like total chaos. One day a stock is a superstar, the next it's in the gutter, all because of a headline or tweet. It just feels emotional, irrational, it's completely unpredictable. It's a place where gut feelings can make or break fortunes, and trying to navigate it can feel absolutely impossible. But what if you had a compass in all that chaos? Well, that's exactly what this man gave us. So let's meet the guy who brought a cold, hard dose of discipline to a world that was and still is often run by pure emotion. This quote, this really gets to the heart of his entire philosophy. What does it mean? It means you stop trying to guess what the market will do next. Instead, you focus on what people are doing. When everyone is giddy and optimistic, convinced a stock can only go up, that's when you consider selling. And when everyone is panicking, full of pessimism and fear, that's your cue to start buying. It's that simple and that profound. This is why they call him the father of value investing. His idea was, honestly, revolutionary. He said, stop staring at that frantic, flickering stock price on the screen. Instead, he taught people to figure out what a business is actually worth. He gave investors a way to cut through all the noise and find the real substance underneath. And look, this wasn't some flash in the pan. His ideas were built over a lifetime. He got his start on Wall Street way back in the early 1900s. But it was his books that really changed everything. Security analysis became like the Bible for professional investors. Then The Intelligent Investor came out and brought these same powerful concepts to regular folks. And oh yeah, he also happened to mentor a certain young man named Warren Buffett. So his legacy, it's pretty secure. So what is this blueprint he created? How do you actually put it into practice? Well, Graham gave us a framework, a way to find order in the chaos. And it all begins with understanding one absolutely critical difference. For Graham, the very first thing you have to do is draw a hard line in the sand. On one side, you have investing. That's when you do your homework, you figure out what a company's really worth, and you're in it for the long haul. On the other side, you've got speculation. That's just a fancy word for gambling. It's betting on which way a price will move, following the crowd, and just trying to make a quick buck. Graham was crystal clear. An intelligent investor knows the difference and never, ever confuses the two. Now, this is the absolute cornerstone of his whole idea, intrinsic value. So I want you to forget about the stock price for just a second. Ask yourself, what is this business really worth? If you bought the entire company, the factories, the patents, everything, what would you actually own? This is all about rolling up your sleeves and digging into the company's financials to figure out a solid, logical estimate of its true value. And this isn't just guesswork. You're not pulling a number out of thin air. Graham laid out a specific process called fundamental analysis. You start by becoming an expert on the company's financial statements. Then you look at the people in charge. Are they any good? You figure out where the company stands against its competitors. And finally, you take a step back and look at the big picture of the economy. It's like being a detective conducting a thorough investigation. Okay, so you've done all your homework. You've come up with a number for the company's intrinsic value. Now we get to what might be Graham's most famous and most important principle, the margin of safety. This is his secret weapon for protecting yourself from risk. The idea is brilliant in its simplicity. Never pay full price. Always buy at a big discount to what you know the business is worth. This makes it super clear. Let's say you do your research and you're confident that a company's stock is worth $100 a share. But because people are pessimistic or there's some bad news, it's actually selling for $60. That $40 difference, that's your margin of safety. It's your cushion. It protects you in case you were a little wrong in your calculations or if things get even worse for a while. That gap is what separates smart investing from pure gambling. But Graham knew that all the spreadsheets and financial analysis in the world weren't enough. He knew that the biggest battle an investor faces isn't in the market. It's the battle that takes place right inside our own heads. He pointed his finger at two major culprits, two emotions that have been wrecking investors' plans for centuries: fear and greed. He understood that it's precisely these emotions that make the market irrational. And that irrationality is what creates the bargains, the mispriced assets that a smart investor can swoop in and buy. But if you let them control you, fear and greed are your worst enemies. Just think about how they work. Fear is that voice screaming, "Sell, sell, get out now," when the market tanks, causing people to sell good companies for pennies on the dollar. And greed, well, that's what we now call FOMO, the fear of missing out. It's what makes people chase after some hot new thing, buying into a bubble and paying way too much. See? They're two sides of the same coin, and both lead to terrible, emotional decisions that can destroy your wealth. So what's the cure for this emotional roller coaster? Graham prescribed an antidote. And it's not easy. It takes patience, the ability to just sit and wait for the market to finally see the value you've already found. It takes discipline to stick to your numbers when everyone else is freaking out. It takes resilience, because sometimes your smart picks might not do anything for a while. And most of all, it means every single decision you make is based on cold, hard facts, not feelings. So you take the deep analysis, you add in the margin of safety, and you mix it with that ironclad psychological discipline. When you put all those pieces together, it's easy to see why Graham's ideas are still so powerful today. I mean, you can draw a straight line from Graham's classroom right to the biggest investment firms in the world. His star student, Warren Buffett, took these exact principles and became, well, Warren Buffett. And today there are thousands of successful value investors all over the globe who are still using the exact same blueprint that Graham laid out all those years ago. And his legacy isn't just some vague philosophy, it's incredibly practical. He gave us real tools we still use every day. Take the PE ratio. All that means is how much are you paying for $1 of the company's profits? Or the PB ratio, which basically asks, how does the stock price compare to what the company's stuff is actually worth? These are standard tools now, and we have him to thank for them. And that's really the bottom line here. What started as a radical idea is now the foundation of modern finance. Graham's principles about doing your homework, managing risk, and not losing your shirt have become the bedrock, the standard operating procedure for smart investors everywhere, from the biggest hedge funds to individuals managing their own money. The reason his work has lasted is because it's timeless. Think about all the ways the world has changed, new technologies, faster markets, and yet his core ideas are just as powerful today as they were in 1949. Why? Because they're not about chasing fads. They're a framework for building real, long-term wealth, not for getting rich quick. It's a philosophy that was truly built to last. Which really brings us to one last thought. In our world of 24/7 news, of trading algorithms and constant noise screaming for our attention, does an approach built on patience, discipline, and quiet, careful thought matter more today than it ever has before? I think that's a pretty good question to chew on. Thanks for tuning in. All right, let's talk about a guy who looked at the absolute chaos of the stock market. The wild swings, the panic, the euphoria, and just thought there has to be a better way, a more rational way. That man was Benjamin Graham. And yeah, he's the one who literally wrote the book on how to invest intelligently when everyone else seemed to be losing their minds. I mean, think about it. This was the one question that really drove Graham's entire life's work. What if? What if investing wasn't just a big casino? What if you could actually strip away all that emotion, all the hype, all the fear, and turn it from a total crapshoot into, well, a disciplined craft? That was his mission, plain and simple. Okay, so to get why Graham was such a game changer, you've got to picture the world he stepped into. We're talking about the early 1900s. Wall Street? It wasn't about careful analysis for most folks. Oh no, it was all about pure speculation. It was pretty much the Wild West of finance. And this right here, this is the core of the problem he saw. A stock's price could just shoot to the moon or totally crash and burn based on what? Rumors, a hot tip, just mob psychology. It had almost nothing to do with whether the company itself was actually solid, making money or owning valuable stuff. It was all just sentiment, just vibes. So the mindset back then? It wasn't, hey, I'm buying a piece of a great business that I want to own for years. Not at all. It was more like, I'm betting this piece of paper is going to be worth more next Tuesday. That's it. It was all about the short-term flip. And that kind of thinking, well, it makes the whole market feel like one giant, dangerous casino, especially for the regular person trying to get by. So who was this guy who dared to look at this whole crazy system and say, nope, we're doing it wrong? Well, to really get Benjamin Graham's ideas, you have to look at his life. Because his philosophy, it wasn't cooked up in some stuffy university library. It was forged in the fire of real personal financial hardship. You see, Graham knew firsthand that gut-wrenching feeling of financial ruin. His family moved to New York from London when he was just a baby, and they really struggled. They faced poverty, and this isn't just some random fact from his biography. That experience burned a lesson into him, a deep, profound need for financial security, and a healthy distrust of unnecessary risk. And what did he do with that drive? He poured it all into his studies. I mean, the guy gets into Columbia University at just 17 years old. 17. He was obviously brilliant, graduated with the highest honors. Basically, he was building an intellectual toolkit that he was going to use to take the entire financial market apart piece by piece. So you've got this brilliant, motivated young man, but the one event that truly changed everything for him, the thing that took his ideas and supercharged them, was a historic disaster he saw with his own two eyes, the Wall Street crash of 1929. And this is so important to remember. Graham wasn't some academic looking at this from a distance. No, he was right there in the thick of it. He was a young stockbroker on Wall Street, actually managing people's money when the bottom just completely fell out of the economy. He saw the panic, the fear, the crazy, irrational decisions people were making, all of it, up close and personal. Just look at that number. -89%. Let that sink in for a second. It's hard to even wrap your head around that. We're not talking about people losing a little money. Entire fortunes, lifetimes of savings, they were just gone, vaporized. For Graham, this wasn't just a market dip. It was proof. Proof that the way everyone was investing was just fundamentally, deeply broken. And right there, that's the turning point. That devastation he saw, it wasn't just a terrible event. For him, it was a call to action. It lit a fire under him and basically forced him to throw out the old rulebook and build something completely new. A framework for investing that was actually based on logic and facts, not just wild guesses and herd mentality. All right, so let's get into the good stuff. Out of the ashes of the Great Depression, Graham built his system, a logical, repeatable, disciplined method that we now call value investing. And believe me, at the time, this was nothing short of revolutionary. So the first big idea, the foundation of everything, is something he called intrinsic value. It sounds complicated, but the idea is simple. Graham said, look, every company has a real underlying worth. It's based on its actual stuff, its assets, its earnings power, completely separate from its crazy fluctuating stock price. You, the investor, your job is to figure out what that real number is. The stock market might say a company is worth $5 a share one day and $20 the next, but Graham's saying, ignore the noise. What is the business actually worth? Now, this next part is what Graham himself called the central concept of it all, the margin of safety. This is genius. Once you figure out what a business is truly worth, its intrinsic value, you don't just go out and buy it. No way. You wait. You wait until you can buy it at a huge discount. It's like knowing a car is worth $30,000 but refusing to buy it for anything more than $15,000. That massive gap between the price you pay and the value you get, that is your margin of safety. It's your cushion. It protects you if you're wrong, and it protects you if the market goes crazy. And when you put them side by side, it's just crystal clear. You've got Graham's approach over here. You think like a business owner. You're digging into the fundamentals. You're in it for the long haul. And then you've got the other side, the speculator. They think like a gambler at a racetrack, just trying to guess which way the crowd will run next for a quick buck. These aren't just different strategies. They're two completely different universes. And here's the thing. Graham didn't just keep these brilliant ideas to himself. He wrote them all down for the rest of us. He co-authored Security Analysis, which is kind of the dense professional's Bible. But then he wrote The Intelligent Investor, which was for everyday people. And that's the book that a guy you might have heard of, Warren Buffett, has called, and I'm quoting here, by far the best book on investing ever written. That's a heck of an endorsement. But Graham knew something else, and this might be the most important part. He knew you could be the world's greatest analyst, a master of numbers, and still fail miserably. Why? Because the biggest enemy isn't the market. It's you. It's your own emotions. He hammered this point home. Having the discipline, the mental toughness to stick to your plan when everyone else is freaking out, that's just as crucial, maybe even more crucial than all the number crunching in the world. So where does all this leave us? What's Graham's legacy today? Honestly, it's impossible to overstate. The guy didn't just come up with a clever new strategy. He created an entire philosophy, a whole school of thought that's been shaping how smart people invest for nearly a century. And his influence wasn't just through his books. He was a professor at Columbia, a revered teacher. And he didn't just lecture, he mentored. He actively shaped the minds of young investors, many of whom went on to become absolute legends in the field themselves. People call him the father of value investing. And that's not just some nice nickname, it's the literal truth. Before him, the whole concept didn't really exist as a formal discipline. He built it from the ground up. He created the vocabulary, laid down the core principles. He gave us the entire framework that millions of people still use today. So let's just recap the sheer scale of his impact. The guy literally codified the principles of value investing. He wrote the definitive books on the subject. He personally mentored Warren Buffett, maybe the greatest investor who ever lived. And today, even with all our computers and algorithms and high-frequency trading, his core ideas, know what it's worth and buy it for less, are as vital and as powerful as ever. Which brings us to a final question, and it's one for you to think about. We live in this world of instant news, of algorithms trading in microseconds. In a world moving that fast, is Graham's old-school wisdom, his call for patience, for discipline, for actually thinking like a business owner, is it just outdated? Or is it maybe more essential now than it has ever been? Something to chew on. Welcome to The Explainer. You know, we hear a lot about investing, But today, we're going to break down a philosophy that has honestly guided some of the world's absolute greatest investors, value investing. No, this isn't about chasing the latest hot stock or tech trend. Nope. It's a really disciplined framework for making sense of the financial markets, which, let's face it, can get pretty chaotic. So let's get into it and unpack how this thing actually works. Okay, so this quote, it really nails the core idea right from the start. I mean, think about all the noise out there, the frantic news cycles, the hot stock tips you hear about. Value investing says, just forget all that. It's not about trying to chase fads or, perfectly time the market. It's about something so much more fundamental, something much more grounded. It's about figuring out what a business is actually worth. So, here's how we're going to tackle this. First, we'll get into the basic philosophy. Then, we'll look at the two main rules from the guy who started it all, Benjamin Graham. After that, we'll talk about the mindset you need, compare value investing to growth investing, and wrap up with why this stuff is still so important today. All right, first up, the value investing philosophy. So what is this all about at its heart? Well, it really just boils down to one central mission, a single quest, figuring out what a company is really worth, completely separate from whatever its stock price is doing on any given day. Okay, so the whole discipline, the entire strategy, it's built around this one big idea, intrinsic value. Think of it like this. Imagine you're not just buying a share of a company. You're buying the whole company, the entire pizza shop, right? You wouldn't just look at the price on the menu. No, you'd look at the ovens, the building, how much money it makes, the cash flow. That stuff, that is its intrinsic value. It's the price a smart, informed person would pay for the whole shebang, not just what the stock market is shouting about it today. And this is a really, really important distinction. It's the difference between being an analyst and being a speculator. See, the speculator is basically rolling the dice, hoping for the best. But a value investor, they're firmly in the analyst camp. You're not a market gambler. You're a business analyst. You're digging into the numbers, looking at cold, hard facts to figure out what something is worth. You're not just betting on which way a squiggly line on a chart is going to go next. And look, this isn't just some vague feeling or guesswork. There's a real toolkit here. It's a process. You're actually rolling up your sleeves and digging into financial statements. You're analyzing earnings and dividends. You're trying to get a real picture of the company's financial health. You also have to understand where it sits in the market. Think about the bigger economic picture. And yeah, you're calculating all those ratios you hear about. The whole point is to use this fundamental analysis to come to a logical, fact-based conclusion about what that company is worth. Okay, on to our next section. Let's talk about the two absolute non-negotiable rules that Benjamin Graham, who's pretty much the father of this whole thing, laid down. These two rules are the bedrock of the entire strategy. So, rule number one, we've talked about this already, but it's so critical it gets its own rule. It's this. You must always figure out a company's true worth before you even think about putting a penny into it. You have to do the homework. You need a solid, logical estimate of its fundamental value. If you don't do that, well, you're not really investing, are you? You're just gambling. And that brings us to the second rule, which is just as important. It's called the margin of safety. So let's say you've done all your homework and you figured out that a company's stock is really worth, say, $100 a share. You don't go and buy it for $99. No way. You wait. You only pull the trigger when the market is offering you a serious discount. Maybe you buy it at $60 or $70. And that big gap between what it's worth and what you paid, that is your margin of safety. And what does that margin of safety do? Well, it's basically your built-in protection, your cushion. It's the thing that shields you if, your own calculations are a little bit off, or if you just run into some bad luck, or the market goes crazy. It's all about playing defense. The number one goal is preserving your capital. Protecting your downside, that comes first always. So, we've got the rules down, but now let's talk about the person who actually has to follow them. And this is huge, because as our source material points out, your temperament as a value investor is every bit as important as your brain power, maybe even more so. And here it is. This is the biggest challenge right here. The market, it's like this giant moody pendulum, swinging wildly back and forth between total euphoria and absolute terror. And the herd, the crowd, they're the ones pushing it, driving prices way, way above or way below their actual value. Your job as a value investor is to just stand there, let the pendulum swing, and stick to what your analysis tells you. It's not easy. So what does this temperament look like? Well, first, you need patience, a lot of it, because it can take a long, long time for the market to realize it got a price wrong. You need discipline, so you can stick to your numbers instead of getting swept up in emotions. You absolutely need emotional resilience, so you don't panic and sell when things get rocky. And maybe most importantly, you have to be a bit of a contrarian. You have to be genuinely comfortable buying when everyone else is selling in a panic. And that's a really important question you've got to ask yourself, honestly. Do you have that temperament? Because this whole approach, it requires the mindset that really goes against our basic human instincts. We want to follow the crowd. And in this game, your own emotions can be your absolute worst enemy. Okay, let's move on. One of the best ways to understand what something is to understand what it's not. So let's compare value investing with its popular cousin, growth investing. And I want to be clear here, these aren't just slightly different ways of doing the same thing. They are totally distinct, fundamentally different philosophies for how you approach the market. And getting that difference is key to really getting value investing. So this chart really lays it out side by side. Think of it this way. A value investor is trying to buy a dollar for 60 cents. They're looking for a bargain today. They're focused on safety, unproven numbers. Now, a growth investor, they're looking for a company that might be worth $10 down the road, even if it costs $1.50 today. They're willing to accept a lot more risk for that shot at a huge reward, and they're usually focused on things like innovation and future potential. And we just saw a perfect real-world example of this, right? Think back to the pandemic. A ton of new investors jumped into the market, and where did they go? A lot of them flocked to those high-flying growth stocks, hoping for those quick, exciting profits. It just perfectly shows you that seductive, emotional pull of growth investing compared to the much more disciplined, almost boring logic of value investing. All right, last section. So here's the big question. This philosophy was developed almost 100 years ago. How on earth does it hold up today? I mean, in our world of high-speed trading, algorithms, crypto, is it still even relevant? Well, the answer, according to our source material, is a huge yes. Actually, the argument is that with all the craziness and uncertainty in today's markets, those core principles, rational thinking, margin of safety, are more important than they've ever been. They're like an anchor in a really choppy sea. And this is a great way to think about it. The what, the core philosophy of intrinsic value and margin of safety, that stuff doesn't change. It's timeless. But the how, the way we actually do the analysis, that has totally evolved. Technology hasn't made Graham's ideas obsolete, not at all. It's actually made them accessible to everyone. The kind of deep analytical tools that used to be only for the big shots on Wall Street, now pretty much anyone can get their hands on them. And so what you get is this really powerful combination, right? Timeless wisdom mixed with modern tools. And what does that do? It empowers you, the individual investor, to take control of your own financial future. It helps build smarter habits, and it really brings to life what Benjamin Graham wanted all along, to help regular folks make smart, solid decisions with their money. So when you boil it all down, what's the ultimate takeaway? It's that value investing isn't a collection of hot tips or a magic formula. It's a way of thinking. It's a disciplined, evidence-based framework that gives you the confidence to handle whatever the market throws at you for the long haul. And that wraps up our explainer on the fundamentals of value investing. So I'll leave you with this final thought to chew on. In a world that is just completely obsessed with speed, with chasing rapid growth, could it be that the single greatest advantage you can have is just good old-fashioned patience? All right, let's get right into it. We're going to talk about one of the most powerful and, honestly, one of the most misunderstood concepts in all of investing. We're talking about intrinsic value, what it really means to find a stock's true worth. So let me ask you a question, and it's a big one. When you look at a stock ticker, you see a price, right? It's flashing green, it's flashing red. But what is that stock really worth? Is that number the whole story? Or is it just the price tag on any given day? This is the question every single serious investor has to wrestle with. And the answer really comes down to understanding this huge difference. Think about it. The market price, that's the popular kid in school. It's swayed by hype, by emotion, by what everyone else is thinking right now. But intrinsic value, that's different. It's based on something real, something fundamental about the business itself. It's the actual underlying worth, not just today's fleeting opinion. Okay, so here's our game plan. We're going to define what intrinsic value actually is. We'll look at how it stacks up against the market price. Then we'll get into the nitty-gritty of how you calculate it, talk about this crucial idea called the margin of safety, and wrap up with the mindset you need to make it all work. Let's dive right in. Section 1, What exactly is intrinsic value? This is the bedrock of it all. So here's the formal definition, but let's break it down. Intrinsic value is what a business is actually worth based on its real fundamental health and its future prospects. The key here is that it's independent of the market price. Forget the stock ticker for a second. Imagine you had the money to buy the entire company, the factories, the patents, the brand, everything. The price you'd be willing to pay after doing all your homework, that's its intrinsic value.
And look, this isn't some newfangled idea. This comes from the godfather of value investing himself, Benjamin Graham. He's the guy who taught Warren Buffett. And his point was simple. If you want to know what something is worth, don't look at the stock chart. Look at the business. Look at its earnings, its dividends, its potential to grow. That's where the real story is.
And this is where it gets really interesting, because figuring this stuff out is part science, part art. The science part, that's the quantitative stuff you see here, the hard numbers. Earnings per share, revenue, cash flow. You can run the numbers on that. But then there's the art, the qualitative side. How good are the people running the show? Does the company have what Buffett calls a moat, a competitive edge that protects it from rivals? You can't just plug that into a spreadsheet. You have to use your judgment. All right, section 2. So we know what intrinsic value is, but why does it matter so much? Well, this is where the rubber meets the road, the battle between market price and real worth. You know, the market has a personality, and sometimes it's a little bipolar. It gets swept up in greed and sends prices to the moon, and then it gets terrified and everything comes crashing down. These swings are driven by headlines, by fear, by FOMO, not always by a calm, rational look at the business. Market prices can be incredibly misleading. And that is why intrinsic value is so critical. It's your anchor in that stormy sea. It's your compass. When everyone else is panicking or getting euphoric, you have this number, this analysis that you've done that tells you what the business is actually worth. It lets you tune out the noise, stick to your guns, and avoid making huge emotional mistakes. So what's the goal of all this? It's simple, really. It's to find bargains. You're looking for those moments when the market, in its emotional state, has slapped a ridiculously low price tag on a really good business. Your job is to spot those opportunities and buy $1's worth of assets for, say, 50 cents. It's about buying great companies when they're on sale. Okay, I know what you're thinking. This sounds great, but how in the world do you actually calculate this stuff? Let's get into it. Section 3, a mix of art and science. So there are a couple of main ways to attack this. On the quantitative side, you've got models like the discounted cash flow, or DCF. That sounds complicated, but all it really is an attempt to estimate all the cash a company is going to make in the future and then figure out what that pile of cash is worth to you today. Or you can use simpler metrics like a PE ratio to get a quick snapshot. But that's only half the picture. You have to combine that with the qualitative side, judging the strength of the brand, the quality of the management, things that give a company lasting power. You need both the numbers and the story. Look, nobody's saying this is easy, but there is a logical process to it. It's like being a detective. First, you dig into the company's financials, the past clues. Then you use that information to forecast where it's headed in the future. Step 3, you assess its defenses, that competitive moat. And finally, after all that legwork, you run the numbers through a model to come up with an estimated value. So you've done all that work. You have your number. But here's the kicker, and this might be the most important part of the whole process. This brings us to what Benjamin Graham called his cornerstone principle. Section 4, the margin of safety. The idea is brilliantly simple. If you think a company is worth $100 a share, you don't buy it at $100. You wait. You buy it when it's trading at a deep discount to that value. That discount is your margin of safety. Think of it like an engineer building a bridge. If the bridge needs to hold 10 tons, they build it to hold 30. That buffer, that's your margin of safety. It protects you if your calculations are a little off or if something unexpected happens down the road. And this chart just lays it out perfectly. Let's say your research tells you the company's intrinsic value is $100 a share. You find it on the market for $60. That $40 gap, that is your margin of safety. It's your protection. It's a huge cushion that gives you peace of mind and, just as importantly, a massive potential for profit when the market finally wakes up and realizes the company is worth that full $100. And this is why it's such a powerful idea. Insisting on that margin of safety does two things at once. First and foremost, it protects your downside. It's your number one defense against losing money. But at the same time, it creates your offense. By buying cheap, you bake in the potential for huge returns. It's really the secret sauce of value investing. All right, our last section. And honestly, you can know all the formulas in the world, but if you don't have this part right, none of it matters. It's not just about the numbers, it's about your mindset. So what does it take? Well, for starters, patience. A lot of it. The market can ignore a cheap stock for a long, long time, and you have to be willing to wait. You also need incredible discipline to not get sucked into the latest craze when everyone else is making quick money. You have to trust your own homework. You have to think like you own the entire business, not just a little blip on a screen. And maybe most importantly, you have to be the master of your own emotions. Greed and fear are the twin enemies of the investor, and you have to keep them in check.
And this really sums it all out, doesn't it? At its core, value investing is an active self-discipline. It's about having the conviction to stick with the principles of valuation, even when, especially when, it's not the popular thing to do.
So, after all of this, what's the one thing I want you to walk away with? It's this. Stop thinking about buying stocks. Start thinking about buying businesses. When you shift your focus from the squiggly lines on a chart to the quality of the underlying business, everything changes. That's the real secret. You know, learning to calculate intrinsic value is like getting a new pair of glasses. It lets you see the market in a whole new way. You start to see value where other people only see bad news. You start to see risk where other people are getting caught up in hype. So the final question isn't about the market, it's about you. Are you willing to put in the effort to see what everyone else is missing? All right, let's get right into it. Today, we're going to unpack one of the most powerful and, frankly, one of the most important concepts in all of finance. It's a core principle designed to be a shield, really, to protect investors like you and me from the chaos of the market. It's called the margin of safety, and it comes from the master himself, Benjamin Graham. But before we define it, let's start with a question. I mean, a real question that I think every single person who's ever put $1 in the market has asked themselves. How do you win a game that, let's be honest, often feels rigged? How do you make smart moves when headlines are screaming and the market is going wild? Well, the answer really begins with understanding this constant tug of war. Investing is a battle that's fought on two fronts, out there in the market and right here inside our own heads. On one side, you've got raw emotion. You know the feeling. It's the fear, the greed, the panic, the stuff that makes you want to sell at the absolute worst time. And on the other side, that's rational investing. It's discipline, it's analysis, it's patience, it's focusing on actual value. Who wins that battle? That determines everything. Okay, so let's dig into that. Section 1, investing's emotional roller coaster. Because this is the fundamental problem, the core issue that Graham's entire philosophy was built to solve. Look, the challenges are very, very real. By their very nature, markets are unpredictable. And because they're made up of people, our human emotions, our gut feelings, they can just steamroll right over logic. That means the risk of losing your money, I mean, really losing it, is always there. And that siren song of speculative excitement, chasing some hot new thing just because everyone's talking about it, that is probably the fastest way to get yourself into serious trouble. So, faced with all that noise and chaos, what's our defense? What's the plan? Well, that brings us right to the solution, what I like to call Graham's shield. This is the margin of safety. It's the antidote to all that market madness. And this quote from Benjamin Graham, the father of value investing, it just says it all. The game isn't won by trying to hit home runs and chasing wild profits. Nope. It's won by being absolutely obsessed with not losing. You focus on minimizing your risk, on protecting your downside. You get that part right, and the profits, they tend to take care of themselves. So what is it exactly? Well, simply put, the margin of safety is the gap between what a company is truly worth, its intrinsic value, and the price the market is selling it for. Just think of it like a buffer, a big financial cushion that you build into every single investment. It's there to protect you from bad luck, from the world going crazy, or even from your own mistakes. Because, hey, we all make them. Let's just walk through this nice and simple. Step 1, your first job as an investor is to be a detective. You have to do the hard work and figure out what a company is really worth based on its assets, its earnings, everything. That number, that's its intrinsic value. Now, step 2, this part's easy. You just look at the stock price. You see what the emotional, sometimes totally irrational market is willing to sell you that company for today. That's the market price. And as you know, that can be all over the place. And this is where the magic happens. The difference, that gap between the true value and the market price, that is your margin of safety. The bigger the gap, the better. The wider the discount, the safer you are. And Graham wasn't kidding around. He wasn't looking for a 5% discount. He often looked to buy stocks for 2/3 of their value. That's a 33% margin of safety, or even better, a 50% discount if he could find it.
Okay, so the theory is solid, right? Buy something for way less than it's worth. But how do you actually figure that out? How do you calculate that investment cushion? Let's get into the how-to.
Graham's method is really a two-part investigation, and this is so important. It is not just about crunching numbers in a spreadsheet. First, yeah, you have the quantitative stuff. You gotta look at the hard numbers. But just as crucial is step 2, the qualitative analysis. That's when you step back and assess the business itself. So let's look at what you're actually digging for. On the quantitative side, the numbers side, you're looking for things like stable, predictable earnings. You want to see that revenue is growing consistently over time. And, this is a big one, you're checking the debt levels. Too much debt can sink a great company. Then, you switch gears. You put on your business analyst hat for the qualitative side. You ask the big questions. Is the management team good at their jobs? And are they honest? Does the company have what Warren Buffett famously calls a moat, some kind of competitive edge that keeps rivals away? You have to have a good story for all of this stuff to have a real margin of safety. Okay, this all sounds great in a calm market, but does it actually work when things get really, really ugly, when the market is in a total freefall? Well, let's look at the proof. Let's see how this idea acts as a shield right in the middle of the storm. And we're going to look at 2 of the toughest stress tests imaginable for any investment strategy: the Great Depression, starting in 29, and the global financial crisis of 2008. I figure if the principle works here, it can work just about anywhere. So our first case study, a company you might have heard of, Coca-Cola. During the Great Depression, the market treated this company like it was about to go out of business. So here's what went down. The market was in an absolute panic, and Coca-Cola's stock price just got hammered along with everything else. But for a value investor, the opportunity was staring them right in the face. The business itself was still rock solid. People were still drinking Coke. The brand was powerful, earnings were fine. The company's true worth, its intrinsic value, hadn't really changed at all, just the price tag. And the investors who saw that, who bought with a massive margin of safety, well, they made a fortune when the world came to its senses. Now let's jump ahead about 80 years to the next big one. Our second case study from the 2008 meltdown is Wells Fargo, a bank that somehow managed to survive while other giants just disappeared. The danger back then for the whole banking industry was just insane levels of debt and crazy risk-taking. But Wells Fargo was different. They had their own corporate margin of safety. They were more conservative, they kept a strong capital base, they were careful about who they loaned money to. And because of that built-in shield, they didn't just survive the crisis that wiped out their competitors, they actually came out of it even stronger. It's a perfect example of how being conservative can actually be the most powerful move you can make. So when you put it all together, what's the big takeaway? It's that the margin of safety isn't just a formula you plug numbers into. It's a discipline. It's a whole mindset about how you approach investing for the long haul. In the end, you should think of the margin of safety as having 2 jobs. It's your shield and it's your guide. It shields you from unexpected disasters and protects your hard-earned money from being wiped out. But it also guides you. It forces you to be careful, to be rational. It's what gives you the backbone to stay calm when everyone else is running for the exits. This is not a get-rich-quick gimmick. It's the bedrock, the foundation for building real, sustainable wealth over time. And so that really leaves us with one final, very important question. A question you have to ask yourself every time you think about buying something. Are you speculating on price? Just betting on whether a number on a screen will go up or down? Or are you investing in value? In the real, tangible, durable worth of an actual business? Because your answer to that single question, well, that's going to define your entire future as an investor.
Let's be honest, if you've ever put money in the market, you know the hardest part isn't just picking a stock. Nope, the real battle is the one that happens right between your own ears. It's that constant tug of war between what your brain knows you should do and what your gut, driven by fear and greed, is screaming at you to do. Today, we're going to break down that internal fight and give you the tools you need to win it. All right, so here's our game plan. First, we'll talk about the market's emotional roller coaster itself. Then, we'll get into how you can actually read the crowd's mood. From there, we'll dive deep into the biases hardwired into our brains that get us into so much trouble. We'll see what happens when emotion takes the wheel, and then we'll finish up with the good stuff, Benjamin Graham's psychological shield to keep you rational. So, let's kick things off with the big one, investing. I mean, it should be simple, right? It's just numbers, logic, and business. So why on earth do we so often become our own worst enemies when our money is on the line? This one. This is the classic, absolutely maddening pattern, isn't it? The market's flying high, everyone's excited, so we jump in. Then things get scary, panic sets in, and we sell at the bottom. We've all felt that pull. And the reason for it isn't buried in some complex financial formula. It's all about how our brain's wired. You can really think of investing as this constant battle between two opposing forces. In one corner, you've got our primal emotions, raw fear and pure greed. And in the other corner, you have calm, rational analysis, the hard work of figuring out what a company is actually worth. The folks who win in the long run, they're the ones who learn how to keep fear and greed in their corner so the rational brain can do its job. And here's the key takeaway from that. The stock market isn't some perfectly logical, all-knowing machine. Not at all. It's really just a giant collection of human beings, all with their own feelings, biases, and hopes. And because of that, market prices can get pushed way, way out of line with a company's real underlying value. Okay, so if we know that this gap between price and value is created by human emotion, what do we do about it? Well, the first step is learning how to actually read that emotional tide. We need to understand what's called market sentiment. So what is market sentiment? It's really just the vibe of the market. It's the collective mood of everyone involved. Is the crowd feeling optimistic and bullish, or are they pessimistic and bearish? This feeling can become a powerful force, almost a self-fulfilling prophecy that, in the short term, can matter a lot more than a company's actual quarterly earnings report. And you can see how this creates a kind of domino effect. The overall sentiment drives people to react emotionally, not analytically. Those emotional reactions lead to stock valuations that are just plain wrong. And, with more and more everyday investors in the market, these emotional waves are bigger than ever, creating these massive gaps between market price and true value. But why? Why are we so easily swept up by the mood of the crowd? Well, the answers are pretty fascinating, and they come from a field called behavioral finance. It's all about the predictable and kind of weird psychological traps that we all fall into. First up is a big one, overconfidence. This is that little voice in your head that whispers, "Hey, you've figured this out. You're smarter than everyone else." It's what makes us take on way too much risk, trade constantly, and think we can outsmart the entire market. It's a dangerous, dangerous bias. Next, we've got something called loss aversion. And check this out. Research has shown that the pain of losing, say, $100 feels about twice as bad as the pleasure of gaining $100 feels good. That's a powerful imbalance. It's why we do irrational things like cling to a losing stock, just praying it'll come back to even, while we rush to sell our winners to lock in a tiny profit. And then, of course, there's the one we've all seen in action, herd mentality. Just think about the big bubbles and crashes in history. It's that powerful fear of missing out, that FOMO, that makes people pile into a hot trend without doing any homework. And it works on the way down, too. That's when panic spreads and everyone rushes for the exits just because everyone else is. So you take these market mood swings, you add in these built-in biases we all have, and what do you get? What's the real-world impact on your portfolio? Well, you get a massive disconnect between how finance is supposed to work in the textbooks and how it actually works in the real world. And this table just lays it out perfectly. You see, traditional finance models are built on this idea that we're all perfectly rational robots who always make the logical choice. But behavioral finance looks at reality. It acknowledges that we're messy, emotional, biased humans, and that our collective feelings are exactly what creates the volatility and the mispricing we see every single day. And this gap right here, between the clean textbook theory and the messy reality of human behavior, this is where the entire game of investing is won or lost. For an investor who's ruled by emotion, that gap is just a minefield of risk. But for the disciplined value investor who understands it, that gap is where all the opportunity is hiding. So that brings us to the solution. How do we protect ourselves from ourselves? Well, the father of value investing, the great Benjamin Graham, he basically created a toolkit for staying rational. It's a disciplined framework that acts as a psychological shield against all these emotional traps. Graham's entire philosophy really boils down to three simple, powerful rules. First, analyze the fundamentals. Forget the market noise and the daily drama. Focus on the business itself. What are its earnings, its assets? Second, always insist on a margin of safety. That means buying a stock for significantly less than you think it's worth. That's your cushion. And third, be patient. You have to treat a stock like you're owning a piece of a business, not like it's a lottery ticket. When you really adopt this approach, it fundamentally changes your entire mindset. You stop trying to guess what the market's going to do next week, and you start acting like a business analyst. You start to see a fearful, pessimistic market not as something scary, but as a fantastic shopping opportunity. It becomes your logical anchor in the middle of an emotional storm. And that quote really brings it all home. In the end, what Graham taught us is that successful investing isn't about being smarter than everyone else. It's about mastering your own emotions. It's about having the discipline to protect yourself from your own worst impulses. So the real question isn't, what's the market going to do? The question you have to ask yourself is, will I have the discipline to stick to my plan? That is the challenge, and it's absolutely the key to winning in the long run.
Hello there, and welcome. Today, we're going to dive into the thinking of a true legend, Benjamin Graham. You've probably heard him called the father of value investing, and for good reason. His principles have been the bedrock for some of the world's greatest investors. So, in this explainer, we're going to break down his core strategies, really get to the heart of them, and see how they can help us find a rational path through what feels like a pretty chaotic market these days. Let's get started. You know, I think we've all asked ourselves this question at some point, right? Especially when you see the markets just swinging wildly up and down. It can really feel like a total game of chance, just driven by pure panic and hype. Well, that feeling, that emotional trap, is exactly what Benjamin Graham's entire philosophy is designed to protect you from. He gives us a real framework to just move past the noise and start investing with discipline. So here's the roadmap for our journey today. First up, we're going to talk about how to tame all that market chaos, mostly by getting a handle on our own emotions. Then we'll get into the absolute cornerstone of value investing, the margin of safety. After that, we'll help you figure out what kind of investor you might be, we'll learn how to crunch the numbers, and understand the story behind a stock. And then finally, we'll pull it all together to see how you can build a portfolio that's truly resilient. Okay, so our very first step is to face what is probably the biggest enemy for most investors: our own emotions. Graham was a firm believer that the real risk isn't the market going up and down, it's how we react to it. That's the dangerous part. This quote right here really gets to the core of the problem Graham was trying to solve. You see, the market is just littered with emotional traps. There's fear when prices are dropping, and then there's pure greed when they're soaring. A value-centered approach, one that's based on facts and solid analysis, it acts like an anchor. It keeps you grounded when those emotional tides are just pulling everybody else out to sea. And here's the interesting part. This imbalance, this emotional roller coaster, it actually creates opportunities for a rational investor. When everyone else is panicking and selling, or they're getting swept up in some crazy hype, they create mispricings. They end up selling great companies for way too little, or buying not so great ones for way too much. So the first step to becoming a really successful investor is just admitting these biases exist, not just out there, but inside all of us. And that leads us perfectly into what is, without a doubt, Graham's most important idea. Seriously, if you only take one thing away from this explainer, make it this one: the margin of safety. It is the central pillar of his whole philosophy. It's your ultimate defense against all the uncertainties that the future is going to throw at you. Okay, so to really get the margin of safety, you first have to understand this concept of intrinsic value. Now, this isn't the stock price you see flashing on your screen. No, this is what the business is fundamentally worth, if you were to buy the whole kit and caboodle. And you calculate it by doing the work, by digging into the financials, looking at the assets, and figuring out its power to make cash, both now and down the road. And here it is, the big reveal, the margin of safety. It's just the difference between that true intrinsic value and the price you actually pay. Think about it like an engineer who's building a bridge. If that bridge needs to hold 10 tons of traffic, they don't design it to hold 10 tons. They design it to hold 30. That extra capacity, that's its margin of safety. For an investor, it's the same thing. It's finding a stock that you've calculated is worth $1 and then buying it for 60 cents. That 40-cent gap is your cushion. It protects you from bad luck, from your own mistakes in calculation, or from a market that just decides to stay irrational a little longer. All right, now that we've got that foundational concept down, let's talk about us. Graham knew that not all investors are cut from the same cloth. He basically split everyone into two main categories, and it's really worth taking a second to think about which one sounds more like you. So have a look. Which camp do you fall into? Over here, we've got the defensive investor. Is your number one goal just to avoid any serious losses? Do you prefer the safety and the reliability of big, established companies that have been around forever? This is more of a hands-off, passive style. Or are you more of an enterprising investor? Someone who's willing to really roll up their sleeves and put in the work to hunt for those hidden gems, those undervalued companies, taking on a bit more risk for the shot at much higher returns. Look, there's no right or wrong answer here. It's all about being honest with yourself about your goals, your temperament, and how much time you're actually willing to put in. All right, so it doesn't matter which path you end up choosing, you're going to need a toolkit. And for Benjamin Graham, that toolkit always starts with the cold, hard numbers. This is the quantitative side of things, where we're looking at a business based purely on its financial statements. Graham used a bunch of different metrics to cut through all the market noise, but he really saw these three as the fundamentals: earnings per share, or EPS, the price-to-earnings ratio, or PE, and the price-to-book ratio, PB. Just think of these as your main diagnostic tools. Put them together, and they give you a pretty powerful snapshot of how profitable a company is and how the market feels about it right now. Let's just quickly break these down. EPS. That tells you straight up about the company's profitability, right down to the per-share level. The PE ratio, that gives you context. A low PE could signal that a company is on sale, maybe undervalued, while a super high one might mean it's pretty expensive compared to what it's earning. And then the PB ratio. That compares the stock price to the company's net worth, according to its books. For value investors, seeing a PB ratio under 1 can be a really interesting sign that a company is worth a much closer look. But listen, a great investment isn't just about finding cheap numbers on a spreadsheet. Graham was very clear that you also have to understand the business itself. And this is the qualitative side. This is the story behind the stock. This is such a critical question. The numbers, they don't tell you about the quality of the people running the show. They don't tell you if customers actually love the product. And they certainly don't tell you if some new competitor is just around the corner, ready to completely upend the entire industry. So this means you gotta dig deeper. Is the management team solid? Are they experienced and trustworthy? Does the company have what Warren Buffett, who was Graham's most famous student, calls a moat? Some kind of durable competitive advantage, like a super strong brand or a unique piece of tech that keeps its rivals at bay. These are the kinds of qualitative things that you're never going to find on a balance sheet, but they are absolutely essential for a company's long-term survival and success. And that brings us to a really key insight here. A true Graham-style analysis is a two-part job. It's both a science and an art. You need that rigorous left-brain quantitative work to find companies that are potentially cheap, but then you need that insightful right-brain qualitative analysis to confirm that you're actually buying a truly good business. Okay, let's zoom out for a minute. Let's go from picking individual stocks to the really big picture, managing your entire portfolio. Because, let's be honest, even a portfolio full of great companies can be a risky bet if it isn't structured with that same level of discipline. A core method for building that resilience is something called asset allocation. It's a fancy term for a simple idea. Don't put all your eggs in one basket. By spreading your investments across different kinds of assets, like stocks and bonds, you naturally lower your overall risk. The idea is that when one part of your portfolio is down, another part might be up, and that helps to smooth out the ride and protect your money over the long haul. And going hand in hand with asset allocation is the discipline of rebalancing. So let's say your target is 60% in stocks. If stocks have a fantastic year, they might suddenly make up 70% of your portfolio. Rebalancing just means you sell some of those stocks to get back down to your 60% target. It's a really simple, almost automatic system that forces you to do what we all know we should do: systematically sell high and buy low, keeping your risk level exactly where you want it. When you step back and look at it, what's so incredible about these ideas is how timeless they are. It didn't matter if it was the 1930s or if it's today. Markets are always going to be driven by two things: human emotion and fundamental business value. Graham's strategies of focusing on that value, demanding a margin of safety, and managing your portfolio with discipline, well, that's an enduring toolkit that can help you succeed in pretty much any environment. And that kind of leaves us with one final thought to chew on. In a world that is obsessed with high-frequency trading, with meme stocks, and a 24/7 news cycle that demands you do something right now, maybe the most powerful, the most rebellious tool an investor has is just good old-fashioned patience. The ability to wait for the right price, to hold steady through the ups and downs, and just let a sound, value-based strategy do its work over time. It's a question really worth thinking about.
Welcome to The Explainer. We're about to dig into what is, without a doubt, one of the most important investment books ever written, The Intelligent Investor. So think of this as our guide to really understanding the financial world with a bit more confidence.
For a lot of us, the stock market can feel just like a casino, right? It's unpredictable, it's really complex, maybe even a little bit intimidating. It feels like it's all just driven by guesswork. But what if there's a smarter, more disciplined way to go about it?
All right, let's jump right in. Here's how we're going to tackle this. First, we're going to look at the market's chaos head-on. Then we'll find our compass with Benjamin Graham's philosophy. After that, we'll break down his core principles, see how they still hold up today, and wrap it all up by exploring the powerful legacy of this wisdom.
So first things first, the chaos. Let's be real for a second. The market today often feels like it's pushing us, almost encouraging us to make these short-term gambles. Instead of building smart, long-term strategies, it rewards knee-jerk reactions, not careful planning.
And we see it play out every single day, don't we? The constant noise, the wild swings, it all tempts people into chasing after those quick, speculative profits. But that is the exact opposite of the patient, disciplined approach you need to actually build real wealth over time. But here's the good news. There is a way to navigate all this chaos. Our guide is a man named Benjamin Graham, and his book, The Intelligent Investor, is basically the compass that every single investor needs. You see, Graham's whole philosophy isn't really about outsmarting the market or trying to predict what it's going to do next week. No, it's about developing a mindset that's really rooted in discipline, in deep knowledge, and maybe most importantly, in emotional strength.
And this is where Graham draws a really sharp line in the sand. On one side, you've got the investor. This is someone who does their homework, does a deep analysis, and treats buying a stock like they're buying a piece of a real business. But on the other side, you've got the speculator. And they're essentially just gambling on market noise, chasing those quick wins. Two totally different worlds.
Okay, so that distinction between investor and speculator brings us right to the heart of his work. We're talking about the foundational principles that allow an intelligent investor to make sound, rational decisions no matter what the rest of the market is doing.
So the very first principle is, well, it's simple, but it's incredibly powerful. You have to do your homework. This is what we call fundamental analysis. It's the whole process of looking past the daily stock price to figure out what a company is actually worth.
And this breaks that process down perfectly. You start with the numbers, the stuff you can measure, things like how much profit the company makes per share, or its price-to-earnings ratio. Then you look at the other side of the coin, the qualitative stuff. Is the management team any good? Does the company have a real durable edge over its competitors? And when you combine those two, that's how you get to what the business is truly worth. Its intrinsic value. And right there, that's the huge mental shift, isn't it? You stop thinking about buying a ticker symbol on a screen, and you start thinking like you're a business owner. Suddenly, every single investment becomes a deliberate choice to become a part owner in a real, living, breathing company.
Now, doing all that deep analysis leads you directly to Graham's most famous concept. This is the cornerstone of his entire philosophy, the margin of safety. This is your ultimate protection against risk, against making a mistake, against just plain bad luck.
Here's a really simple way to think about it. Let's say your analysis tells you a company's stock is really worth $50 a share. Well, the margin of safety principle says you don't buy it at $49. No way. You wait patiently for an opportunity to buy it at a steep discount, maybe $30. That $20 gap, that is your margin of safety. It's your buffer, your protection, if things don't go exactly as planned. Okay, so I know what you might be thinking. That all sounds great for the 1950s, but how on earth do these ideas hold up in today's world? With everything moving at the speed of light, with all the complexity we have now? It's a fair question. And the truth is, things are more complicated now. We've got complex corporate buyouts, stock options to account for, a flood of data coming at us 24/7. But here's the thing, Graham's core principles give us a stable framework to cut through all that noise. We can use all the modern analytical tools we want, but the fundamental goal never, ever changes. Focus on the real underlying value of the business. Because at the end of the day, despite all the changes, the fundamentals of the intelligent investor's mindset, that's patience, discipline, and a relentless focus on analysis, are actually more relevant today than they've ever been. They are the timeless tools you need for real long-term success.
So, for our last section, let's look beyond just personal investment strategy.
Because Graham's philosophy, it's really more than that. It's a kind of financial wisdom that can create a powerful, lasting legacy.
Think about it. When we teach these principles, patience, doing your homework, making careful decisions, to young people, we're not just giving them stock tips. We are building a solid foundation for a lifetime of financial responsibility and true well-being.
And probably one of the most powerful lessons we can possibly pass on is the absolute magic of compounding. When a young person really understands this concept, it empowers them. It shows them that time, not timing the market, but time itself, is their single greatest asset when it comes to building real wealth.
And you know, when families start having these conversations openly, when they talk about investment ideas, the importance of a margin of safety, they create this powerful tradition. Financial education stops being a scary topic and it becomes a shared family value. And that strengthens the whole family's financial health for generations.
So if there's one thing to really take away from all this, it's this. The principles from The Intelligent Investor are about so much more than just making money. They're about cultivating a mindset of discipline, of foresight. They are a blueprint for building a secure, prosperous financial future, not just for you, but for the generations that come after you. So the only real question left is, what financial legacy will you build?
You know, we've all been there. Someone gives you that hot stock tip. But what if the real secret to building wealth isn't about getting lucky, but about mastering a skill? Well, today, that's exactly what we're diving into: security analysis. We're going to unpack the timeless principles from the man who literally taught Warren Buffett how to invest, the one and only Benjamin Graham. This isn't about quick wins. It's about building a rock-solid foundation for your financial future.
So let me ask you this, and be honest. When you put your hard-earned money into the market, are you truly investing, or are you kind of just guessing? It's a simple question, but the difference between those two is absolutely everything. Today, we're breaking down the core skill that makes sure you stay on the right side of that line.
All right, so here's the game plan for today. First up, we'll nail down what security analysis actually is. Then we get to the fun part, the constant battle between cold, hard numbers and our own messy human emotions. After that, we'll crack open the analyst toolkit, see how to put Graham's legendary strategy to work, and finally, we'll zoom out and look at how all this affects more than just our bank accounts. Let's do it. Okay, section 1. Let's get right to the heart of it all. What in the world is security analysis? You can think of this as the powerful engine driving the entire philosophy of value investing. It is the absolute core of everything Benjamin Graham taught, and getting a handle on it is, well, step 1.
Think of yourself as a detective, but for your money. That's really what security analysis is. It's the nitty-gritty process of digging into a company's stock or its bonds to figure out two really important things. First, what is this thing really worth? Its intrinsic value, completely separate from all the market hype. And second, what's its real potential down the road? See, you're not just glancing at the price tag, you're investigating the whole story.
And this, right here, is why it is so incredibly important. Mastering this skill is what separates a thoughtful, logical investor from someone just gambling on market noise. It's what gives you the confidence to know the difference between a genuine opportunity and, well, just a roll of the dice.
All right, let's move on, because this is where things get really interesting. You see, great analysis isn't just about crunching numbers in a spreadsheet. It's this fascinating mix of hard data and the wild, unpredictable world of human psychology. Every single investment has these two sides to it.
This really breaks it down perfectly. It's like you need to have two brains working at once. On one side, you've got the quantitative stuff. This is all the numbers, the financial reports, PE ratios, cash flow. It's the math. But then, on the other side, you have the qualitative, the human factor. This is all about understanding fear and greed, the mood of the market, and all those little mental shortcuts or biases that make us act irrationally. A truly great investor isn't just good at math. They're also part psychologist. You have to master both.
And this quote from Guillaume Denis just nails it. As more and more people have gotten into the markets, we're seeing huge swings that are driven not just by facts about a company, but by how we all feel. Fear and greed are incredibly powerful forces, and you can't ignore them.
And you know, those emotions lead us right into these classic mental traps. We do things like following the crowd, where everyone just runs in the same direction, sometimes right off a cliff. Or we overreact to the latest scary headline. We get overconfident and take on way too much risk, or we think an investment is safe just because it feels familiar. A solid analytical process is your best defense against your own brain.
So, If we know our own minds can play tricks on us, how do we fight back? How do we actually figure out what a company is truly worth? Well, it's time to open up the Analyst Toolkit and look at the most important tool of all.
And that primary tool, the cornerstone of this entire approach, is called fundamental analysis. This is Graham's bread and butter. It means you're doing a complete, top-to-bottom deep dive into a company's financial health, its position in the market, everything. No shortcuts. Now, this might sound complicated, but you can really break it down into 4 straightforward steps. Step 1, you dive into the financial statements, the income statement, balance sheet, cash flow. You gotta know the numbers. Step 2, you evaluate what the company owns versus what it owes, its assets and liabilities. Step 3, you zoom out and look at the big picture, what's going on in the economy. And then, and only then, after all that homework, do you get to step 4, making an educated guess at the company's real intrinsic value.
A good way to think about it is that you're looking at things on 3 different levels. First, you've got the super specifics of the company itself, earnings, debt, that kind of thing. Then you pull back the lens to look at the whole economic environment. How will inflation or interest rates affect this business? And finally, you have to assess the people in charge, the management. You need the full picture, from the ground level all the way up to the 30,000-foot view.
Okay, enough theory. How do we take all of this and actually use it? Let's talk about putting these timeless principles from Graham into action and applying them to a real-world portfolio.
So one of the first and most fundamental rules for managing risk is diversification. It's really that simple. You can't predict the future, so the last thing you want to do is put all of your eggs in one basket. Spreading your investments around isn't just a suggestion, it's a core defense.
And a diversified portfolio could look something like this. You're spreading your money across different kinds of assets. You might have stocks for growth, bonds to provide some stability, maybe even some real estate. The whole idea is that when one part of your portfolio is having a bad month, another part might be doing just fine, and that helps smooth out the whole ride. Now listen closely. If you only take one single idea away from our talk today, please make it this one: the margin of safety. This is Benjamin Graham's masterpiece. The concept is so simple, but it is the absolute bedrock of value investing. It just means you only buy something when its price in the market is significantly below what your analysis tells you it's actually worth. That difference, that cushion, that is your margin of safety. It protects you when you're wrong, it protects you from bad luck, it's your buffer against chaos. And really, all of this comes down to which side of this chart you want to be on. You've got the speculator who's always chasing the latest trend, reacting to every news alert, hoping for a quick score, and then you've got the true investor. They're focused on the fundamentals, they understand the value of patience, and they're aiming for steady, long-term growth. Graham's entire philosophy is about training yourself to be the person on the right. Okay, for our last section, I want to zoom out a bit. Because doing this right, investing with a focus on real value, it's about more than just your own bottom line. The way we invest has a real, tangible impact on the world around us. Just think about the ripple effects for a second. When we invest our capital in solid, well-run, responsible companies, we're doing more than just trying to make a return. We are actively helping to build a more stable economy. We're supporting sustainable growth, creating wealth that can last for generations, and we're sending a loud and clear message that we value careful, responsible leadership. And that's a really powerful idea to sit with. Investing is never a passive activity. Every single dollar you put into the market is a vote. It's a vote for the kind of companies you believe in, the kind of business practices you support, and the kind of future you want to live in. Your choices today are literally helping to build the world of tomorrow. So I'll just leave you with this one last question to think about. When you look at your own portfolio, is it built for the long haul, ready for the future, whatever it may bring? Or is it just chasing whatever seems hot tomorrow? The answer to that question, well, that's what makes all the difference. Thanks for tuning in.
All right, let's dive right in. We're about to pull back the curtain on one of the most powerful, yet honestly most overlooked signals in the entire stock market. We're talking about a single number that tells you so much about a company's health, its confidence, and its commitment, directly to you, the shareholder. So think about it for a second. We're all bombarded, right? Daily price swings, flashy news headlines, talking heads telling us what's hot. But what if I told you there's one number that quietly, consistently tells a much deeper story about a company's real long-term value? What is it?
Yup, it's the dividend. And I know what some of you might be thinking. Oh, that's just a small bonus check. But no, it's so much more than that. It is the unsung hero of a truly solid long-term investment strategy. And over the next few minutes, we're going to show you exactly why.
So here's our game plan. First up, we'll talk about why dividends are the unsung hero of investing. Then, we're going to learn how to decode the powerful signals they send out. After that, we'll see how they act as a kind of shield for your portfolio. And then, my favorite part, we'll unleash the incredible snowball effect of compounding. Finally, we'll wrap it all up into a new principle you can use for life.
Okay, first up, the unsung hero. The big idea here is simple, but really powerful. A dividend is so much more than just leftover cash. For a smart investor, it's a direct signal of a company's character and its true financial muscle. You see, when a company pays a dividend, it's actually doing 4 amazing things all at once. First, it's directly rewarding you for your ownership. It's your piece of the profits. Second, it's signaling some serious confidence in its own ongoing profitability. It's also providing you with a steady, reliable stream of income. And as we're going to see, it's handing you the keys to an incredible engine for building wealth.
And that leads us perfectly to our second section, decoding the signal. Because you have to understand, a dividend isn't just a financial transaction. It's a message, a powerful one, sent directly from the company's boardroom straight to you.
Think of it like this. Any CEO can get on TV and say things are great. But consistently paying a dividend, that takes real discipline. It forces management to be smart with their cash flow and investments. It's basically a public declaration of stability and a promise that they take shareholder value seriously. Words are cheap, but cash is king. And this slide, well, it shows the 2 different stories a company can tell. On one side, you have a company with a stable dividend. It's signaling strengths, confidence, and good governance. It's a company that attracts loyal, long-term investors. On the other side, well, that's a much more uncertain path. An erratic or non-existent dividend can signal instability, risky bets, or sometimes even financial trouble. The signal couldn't be clearer.
And this is exactly why the investing legends, guys like Warren Buffett, pay such close attention to dividend policies. Just think about a company like Coca-Cola, a classic Buffett favorite. It's paid a dividend for over a century and has increased it year after year for decades. Now, that is not an accident. It's a signal of a durable business, a moat, as they call it, and a management team that's focused on returning capital to its owners. It tells you this is a business built to last.
Okay, so let's talk defense. Because let's face it, the stock market can be a pretty volatile place. But dividends, well, they can act as an investor's shield. And for any true value investor, protecting your capital is rule number 1. And this idea, it's not some new fad. It comes directly from Benjamin Graham and David Dodd, the absolute godfathers of value investing. They argued that a reliable dividend acts like an anchor, grounding a stock's value and providing stability, especially when the market waters get choppy. So dividends provide stability in 2 ways, financially and, just as important, psychologically. Financially, that regular cash flow means you're not just desperately hoping the stock price goes up every single day. And historically, these kinds of stocks are just less volatile. But psychologically, getting paid real cash, that reinforces your strategy. It gives you the confidence, the staying power to stick to your plan when everyone else is panicking. We've covered the signal, and we've covered the shield. Now let's get to the really exciting part. Let's talk about the almost magical ability of dividends to generate exponential growth when you put them back to work. This is the compounding snowball. So how do we do this? The mechanism is often called a DRIP, which stands for a dividend reinvestment plan. And it's incredibly simple. Instead of taking the dividend cash and spending it, you just automatically use it to buy more shares of the very same company, often with no extra fees. You set it and forget it. This creates this beautiful virtuous cycle. Check it out. You get paid a dividend. You automatically use it to buy more shares. That means you now own a bigger piece of the company. So the next time dividends are paid out, your payout is bigger, which of course buys you even more shares. And the snowball of your wealth just gets bigger and bigger, and it starts rolling faster and faster over time. It's powerful stuff. And hey, don't just take my word for it. Just look at the dramatic difference this can make. Let's say you invest and over 20 years, your portfolio grows to $100,000. Not bad, but look what happens if you simply reinvested all the dividends along the way. That same portfolio could be worth $180,000. That extra 80 grand, that's not money you put in.
That's your money working for you, creating its own earnings. The growth doesn't just add to your returns, it multiplies them. This is the real engine of long-term wealth creation.
Okay, so let's bring this all home. Understanding dividends isn't just another little investing tactic. It's really a fundamental shift in how you see the market. It's about giving yourself a new, more powerful lens to evaluate any company you're thinking about.
So, what's the bottom line here? If you walk away with anything today, I want it to be these 4 things. 1, dividends are a vital sign of a company's health and discipline. 2, they are a defensive shield when markets get crazy. 3, reinvesting them is the fuel for your long-term growth engine. And 4, for any serious investor, analyzing a company's dividend policy isn't optional. It's absolutely essential. So I'll just leave you with this one question. The next time you're researching an investment, don't just get caught up in the daily stock price. Look deeper. Really listen to the quiet, consistent, and powerful story that the dividend is telling you. It might just be the most valuable signal you'll ever find. All right, let's talk about a word that causes more heartburn and confusion for investors than pretty much any other: risk. But here's a thought. What if the way we've all been taught to think about it is just, well, completely backwards? Today, we're going to break down that old idea and rebuild it from the ground up using the incredible wisdom of a true investing giant. And there it is. This one line from the man himself, Benjamin Graham, the father of value investing, it just changes the entire game. He's telling us that all that daily noise, the stock prices bouncing around that the news channels are obsessed with, that's not the real danger. No, the real danger is something much scarier and much more permanent. And that right there, that's the multi-trillion-dollar question, isn't it? I mean, if we're supposed to ignore the market's daily mood swings, what should we be paying attention to? Because once you make this mental switch, I'm telling you, it changes everything about how you approach investing and protecting your money. So here's our game plan. We're going to walk through this step by step. First, we'll get crystal clear on what investment risk actually is. Then we'll look at Graham's brilliant solution for it. After that, we'll see how this whole thing connects to your returns, get into some real practical strategies you can use, and then we'll finish with the most critical piece of the puzzle, your own mind. Okay, first things first. Before we can build anything, we have to clear the ground. We need to completely tear down that old, shaky definition of risk and replace it with something solid. Believe me, this is the foundation for everything else we're going to talk about. And here you can see it side by side. The common view on the left. That's what keeps people glued to their screens, right? Panicking at every dip, getting euphoric at every peak. It's exhausting. But Graham's view over on the right, it's liberating. It basically says, forget the noise. You only need to focus on one single thing. The possibility that you could permanently lose your money. That's it. So if we want to avoid that permanent loss, Graham says we have to stop acting like stock pickers and start acting like business owners. You've got to dig deep into the stuff that actually matters for a company's future. What's happening in the broader market, how good is the company's management, what's going on in their specific industry, and even things like how they treat their people. It all matters. So, if the absolute number one thing we want to avoid is permanently losing our money, how do we actually do that? Well, this is where Graham gives us this incredibly powerful and honestly beautiful tool. And this is really the heart of it all. It's so simple, but so profound. The idea is you're not just buying stocks, you're buying pieces of a business. And you only buy when you can get it for a lot less than what your homework tells you it's actually worth. That difference, that discount, that's your margin of safety. It's your buffer. Let's look at a chart to make this really clear. Imagine you've done all your research, you've kicked the tires, and you calculate that a company is really worth about $100 a share. That's its intrinsic value. But then you look at the stock market, and for whatever reason, maybe people are just panicking, it's selling for $60. That $40 gap between what it's worth and what you pay, that is your margin of safety. It's the cushion that protects you if you made a mistake, or if the world just goes a little crazy for a while. Okay, now let's talk about that classic idea of risk versus return. We've all heard it 1,000 times. To get higher returns, you have to take on higher risk. It sounds right, doesn't it? But Graham's philosophy? Well, it kind of flips that whole idea right on its head. And this is the idea that gets so many investors into trouble. It's this siren song that lures people into chasing after the hottest new thing, these speculative bets, without ever really stopping to think about the cliff they might be running towards. You're chasing the reward, but totally ignoring the real risk involved. And here's the big twist. Graham says your number one job is not to find the highest returns. Your number one job is to avoid losing money. Period. You focus on defense first. You insist on that margin of safety. And the funny thing is, when you get really, really good at minimizing your risk, the solid returns just kind of take care of themselves over time. Okay, this is where we get down to brass tacks. Understanding the philosophy is one thing, but you need tools you can actually use. So let's go over the key strategies that value investors use day in and day out to put all this theory into action. I like to think of these as the three legs of a stool. You've got diversification, fundamental analysis, and systematic investing. Any one of them is good, but when you put all three together, that's when you build something truly strong, a portfolio that can handle whatever the market throws at it. This one's the classic. I'm sure you've heard it a million times. Don't put all your eggs in one basket. And it's a classic for a reason. It works. By spreading your money around different companies, different industries, even different countries, you make sure that if one of your investments goes sour, it doesn't take your whole nest egg down with it. Now this is the real grunt work. This is what separates investing from just plain gambling. You have to put on your detective hat. You're digging through financial reports. You're trying to understand what makes a company special. You're calculating what you think the business is actually worth. And you do all of that before you even glance at the stock price. You know, for most of us today, this is probably one of the most powerful and accessible ways to put Graham's ideas to work. By just investing the same amount of money on a regular schedule, like every month, out of your paycheck, you take the emotion out of it. You end up automatically buying more shares when prices are low and fewer when they're high. It forces discipline and stops you from playing the guessing game of trying to time the market. All right, so we've got the principles, we've got the strategies. But I've got to tell you, even with the perfect plan, the biggest threat to your financial success isn't a market crash. It's the person looking back at you in the mirror every morning.
Let's be honest, our brains are just not wired to be great investors. We're emotional creatures. When markets are tanking, our gut screams sell. When they're soaring, our greed kicks in and we want to pile in more money. We're programmed to do the exact wrong thing at the exact wrong time.
And here are the usual suspects. Overconfidence, thinking you're the one person who can predict the future. Fear, letting panic force you to sell at the absolute bottom. And trend chasing, getting caught up in the hype and buying something just because it's going up. Graham's entire framework is basically a defense system designed to protect you from these exact mental traps.
So here's the bottom line. Having a solid plan, one that's built on a rock-solid principle like the margin of safety, does two things for you. It protects you from the market's craziness, for sure. But more importantly, it protects you from your own perfectly normal but financially dangerous human emotions.
And really, that's what this all boils down to. You can't control the economy. You can't control what the market does tomorrow. It's totally, completely out of your hands. But you know what you can control? Your homework, your process, your discipline, and most of all, your own reactions. If you focus on mastering those things, you'll be able to handle whatever comes your way. So the question isn't, what's the market going to do? The real question is, what are you going to do?
We've all been there, haven't we? You look at the news and the market is soaring one day and plunging the next. For any investor, these economic cycles, well, they're not just headlines. They are the constant weather we have to navigate. So today, we're going to dig into how these massive shifts create both huge risks and, believe it or not, some incredible opportunities. And we'll see how the timeless strategy of value investing can be our compass through it all. And that really gets us to the heart of the matter. When the market gets choppy and the headlines are all about doom and gloom, or maybe even wild euphoria, should you see that as a threat to your portfolio, or is it something else entirely, a hidden opportunity? The truth is, it all comes down to your mindset, and more importantly, your strategy. Okay, so here's our roadmap for today. First, we'll look at the economy as a kind of weather system. That'll lead us right into its two main seasons, the booms and the busts. Then we're going to get super practical and look at how value investing works in the good times and in the tough times. After that, we'll tackle what might be the hardest part of all, our own psychology, before we pull it all together and talk about building a truly resilient portfolio. So let's start with section 1, the economic weather system. You know, it's a really powerful way to think about it. You can't control the rain, right? But you can absolutely bring an umbrella. Economic cycles are exactly the same. They're just the climate we all invest in. So the first step isn't trying to predict them, it's learning how to prepare for them. And really, who better to guide us than the father of value investing himself, Benjamin Graham? His whole philosophy was, at its core, pretty simple. You have to know the real value of a company, its intrinsic value. But here's the kicker that so many people miss. That value isn't set in stone. It changes based on the economic situation. For example, when interest rates go up, the value of a company's future earnings actually goes down. This single idea is the foundation for everything we're about to talk about.
All right, so building on that, let's jump into Section 2, Understanding Booms and Busts. We've got to clearly define these two phases because, they're not just random, chaotic events. They are a natural, recurring part of how the economy functions.
So what is an economic cycle, really? Well, put simply, it's the economy's natural rhythm. It breathes in and it breathes out. You have periods of growth, which we call expansion, and you have periods of decline, or contraction. And the one thing you can absolutely count on is that neither one of those phases will last forever. And these two environments, they are like night and day. During an expansion, a boom, it feels like everything is going right. Job growth is strong, people are spending, businesses are investing. It feels like the party will never stop. But then you have the bust. The reverse happens. Indicators fall, earnings shrink, and fear takes over, causing panicked investors to sell everything at pretty much the worst possible time. For an investor, these are two totally different worlds to navigate. So that brings us to our first big strategic question. How do we do this in the good times? When the economy is roaring and we're in a bull market, it feels like the easiest time in the world to make money. But honestly, for a disciplined value investor, this is exactly when the alarm bell should be going off. It's a time that's actually filled with hidden traps. And here's why. In a boom, stock prices often get completely detached from reality. They're driven by pure speculation and hype, not a company's actual performance. The temptation to just follow the herd is huge. And this is also where you find the dreaded value trap. A stock that looks cheap on paper, but it's a trap because the business itself is fundamentally broken and it's never coming back. That market euphoria, it's like a siren song, pulling undisciplined investors toward the rocks.
So how do you protect yourself from all that? The answer is just relentless discipline. It means you're doing the hard work, the fundamental analysis. You're digging into balance sheets, you're reading the reports, and you're sticking to your strict standards for what makes a quality investment. Frankly, it means having the courage to say no thanks to the party and just patiently waiting for those rare, genuine opportunities to show up.
Okay, so now let's flip the coin and talk about the other side, investing in tough times. When the market is in a freefall, a bear market, and fear is absolutely everywhere, most people just want to run for the hills. But for a true value investor, this is when things get really interesting. This isn't a disaster, it's a fire sale.
See, this is why downturns are so powerful. All that emotional, panicked selling creates huge mispricings all over the market. All of a sudden, fantastic, high-quality companies get put on the discount rack. The key is to find those businesses with rock-solid finances that can weather the storm. You want to think about defensive sectors, companies that sell things people need no matter what the economy is doing. People still buy toothpaste and toilet paper in a recession, which makes those businesses incredibly stable.
So at the end of the day, the strategy in a downturn has two parts. First, you preserve your capital. Job number one is don't lose money. Don't take wild risks. And then, part two is you selectively deploy that capital, buying up those wonderful, resilient companies that are now on sale. You're not just surviving the downturn, you're actively planting the seeds for your future growth.
Now, all of this, it sounds perfectly logical on paper, right? But knowing the strategy is actually the easy part. The real challenge is actually doing it when your own emotions are screaming at you to do the exact opposite. And that brings us to maybe the most important section of all, mastering your market psychology. The inner game is often the one that decides if you win or lose.
And here's the problem. We are not rational machines. We're human. We are hardwired with these emotional biases that just distort our judgment. Fear and greed are incredibly powerful forces, and if we're not paying attention, they will cause us to do exactly the wrong thing at the wrong time, to sell in a panic at the bottom and buy in a frenzy at the top.
There's a whole field dedicated to this. It's called behavioral finance, and it's basically the owner's manual for your own investing brain. Understanding these psychological traps isn't just some academic thing. It's literally the key to building a defense against your own worst instincts.
So here's a concrete 3-step plan to build that mental fortress. Step 1, just acknowledge your biases. Be honest with yourself. Accept that you will feel fear when the market crashes. Step 2, create your systematic investment plan when you are calm and rational, not in the heat of the moment. And step 3, write down your long-term goals and stick them on your monitor. They become your anchor in a volatile sea.
Okay, let's bring it all home now in our final section. This is where we tie everything together. The market cycles, the value strategies, the psychology, and turn it into a practical framework for building a portfolio that can handle whatever the economy throws at it.
It all really boils down to these 4 pillars. First, you have to keep a long-term perspective and just refuse to get shaken out by the short-term noise. Second, you got to do your homework, that deep fundamental analysis of a company's real value that Graham taught us. Third, stay aware of the big picture. Understand how things like inflation and interest rates are changing the playing field. And finally, the golden rule. Base every single decision on your systematic plan, not on the market's mood swings.
And here's the bottom line, the crucial takeaway from all of this. A disciplined, informed value investing approach does way more than just help you survive economic cycles. It actually empowers you to use them to your advantage, turning market volatility from your biggest threat into your single greatest opportunity.
So I'll leave you with just one question to think about. We've talked about a lot today, from market analysis to our own psychology. The next time the market makes a big move, up or down, what is the one principle from today that you are going to commit to applying? Because deciding that now is what will prepare you for what's inevitably ahead. Thanks so much for tuning in.
Welcome to The Explainer. Today, we're diving deep into the mind of the man who literally taught Warren Buffett how to invest, the one and only Benjamin Graham. We're going to break down the simple yet incredibly powerful ideas that turn the stock market from a casino into, well, something you could actually analyze. And you'll see why these ideas might be more important than ever in the crazy financial world we live in today.
We're starting with this quote because, honestly, it's his entire philosophy packed into one sentence. The whole idea is to completely detach yourself from the emotional roller coaster of the market. You ignore the hype, you ignore the panic. All you do is focus on the cold, hard facts of what a business is actually worth. This right here, this is the bedrock of the rational thinking that made investors like Warren Buffett legends.
All right, so here's the game plan. We're going to start with the man himself, then look at his huge impact on Buffett. After that, we'll see how his ideas grew and changed over time, ask if they even still work today, and then we'll wrap up with what his legacy really means for all of us.
Okay, first up, the father of value investing. You have to understand, before Graham came along, the stock market was pretty much a giant casino. People were just gambling. He walked into this chaos and introduced 2 game-changing ideas. First, that a stock isn't just a lottery ticket, it's an actual piece of a business. And second, that you should never, ever overpay for it. Simple, but revolutionary.
And this right here was his first big move, drawing a thick, bold line in the sand. Over on one side, you've got speculation, which is basically just betting on which way a stock's price is going to wiggle next. But on the other side, you have investing. And for Graham, investing meant you were buying that stock as if you were buying the whole darn business. It's a total shift in mindset, right? Moving away from watching charts and toward thinking like a long-term business owner.
That leads us straight to his first core concept, intrinsic value. Graham taught investors to just ignore the day-to-day noise of a market and instead act like a detective. Your one job is to figure out what a business is really worth based on its real-world stuff, its assets, its earnings, its cash flow. That ticker price you see flashing on the screen, that's just the market's mood swinging all over the place. The intrinsic value, that's the reality.
And his second pillar? Oh man, this might be his most famous idea of all, the margin of safety. The best way to think about it is like a seatbelt for your money. So once you figure out what a company is truly worth, you don't actually pay that price. Nope, you wait. You got to be patient. You wait until the market gets scared and offers that company to you at a big discount. That gap, that cushion between the real value and the price you pay, that's your margin of safety. It's what protects you when you're wrong or when bad luck strikes. So you may be wondering, how powerful are these ideas in the real world? Well, to see that, we've got to look at Graham's star pupil, a guy named Warren Buffett. He took this exact framework and used it to build, well, one of the greatest investment track records in human history. And the connection between them isn't some fuzzy, indirect thing. It's a straight line. Buffett has said over and over again that Graham's book, The Intelligent Investor, is the single best book on investing ever written. He read it when he was young and said finding it was one of the luckiest days of his life.
This isn't just a small influence. Graham's principles are baked into the core of Buffett's financial DNA. Now, here's where it gets really interesting, seeing how a brilliant student builds on the master's work. Buffett took Graham's foundation, all the hard numbers, the quantitative stuff, and he kept it. But then he added this whole other layer on top, the qualitative side. He didn't just ask, is this business cheap? He started asking, is this a great business? He looked for stuff you can't always find on a spreadsheet, like incredible managers and a durable competitive advantage, what he famously calls a moat that can protect a company for decades. But Graham's influence didn't just stop with Buffett. His ideas were kind of like a stone thrown into a pond. The ripples just kept spreading, inspiring whole new generations of investors who took his core principles and ran with them, proving just how solid that original framework really was. And what this timeline really shows us is that value investing isn't some dusty old theory stuck in a textbook. It's a living, breathing philosophy. It started with the super dense academic security analysis way back in 1934. Then he made it accessible for everyone with the Intelligent Investor in 1949. Then it got supercharged by Buffett in the 1960s, and it's still being tweaked and adapted by modern investing masters today. I think the real genius here is just how flexible the whole framework is. You've got guys like Seth Klarman, who's a total purist. He's absolutely obsessed with the margin of safety. Then you have someone like Joel Greenblatt, who tried to turn it into a system with his magic formula. And maybe most important of all, you've got millions of regular, everyday people who have used Graham's simple, logical approach to build their own financial security. Okay, so this all leads us to the big, and I mean the big, controversial question. Do these principles, which were born in an age of paper stock tickers and ledgers, do they still hold up in our world of AI, high-frequency trading, and instant information? And look, the skeptics, they have a point. They'll argue that Graham's old-school methods, looking for companies trading for less than the value of their physical assets, just don't work so well anymore. I mean, how do you use those old tools to value a software company where the biggest asset is code, or a social media giant whose value is built on its network of users? It's a fair question.
But here's the powerful counter-argument. Technology doesn't make Graham's ideas obsolete. It actually makes them stronger. Today, we can use software to screen thousands of companies for his key metrics in a matter of seconds. We have access to more information for our analysis than he could have ever dreamed of. But that last step, the most important one, having the discipline to act rationally and not get swept up with the emotional herd, that's still a human skill. And that's the one Graham cared about most. In fact, you could make a really strong case that his ideas are more vital today than ever before. Think about it. We live in an age of meme stocks, crypto bubbles, and a 24/7 news cycle designed to create panic and hype. In all that chaos, Graham's philosophy is like an anchor in a hurricane. When everyone else is chasing noise, his principles give you a solid framework to find the real signal. And maybe most importantly, to protect your money.
All right, let's bring this all home. Let's boil everything down to the essential, timeless wisdom that makes Benjamin Graham's philosophy such a critical guide for any investor, even today. At the end of the day, it really comes down to these 4 pillars. Number 1, you gotta think like you own the business, not like you're just betting on a stock ticker. Number 2, always protect your downside by demanding that margin of safety. 3, you have to master your own emotions so you're never a slave to the market's crazy moods. And 4, understand that building real wealth is a marathon, not a sprint. It takes patience and discipline, 2 things that are incredibly rare in this world. And that really leaves us with one final, and I think pretty deep question. In a market that is completely obsessed with speed, with algorithms, and with finding the next big thing overnight, has Graham's philosophy accidentally revealed the ultimate competitive advantage? Maybe the most powerful tool an investor has isn't a faster computer or some secret formula, but simply the disciplined patience to wait for the right opportunity.
All right, welcome everyone. Today, we are going to tackle one of the most legendary, but also one of the most misunderstood investment strategies out there, value investing. For all its fame, it's really surrounded by this fog of confusing ideas and honestly, half-truths that can lead even the smartest people down the wrong path.
You often hear it framed in these 2 extremes, right? Is it this magic shortcut to getting rich, or is it just some outdated, clunky method that's a slow road to absolutely nowhere? And that question, it gets right to the heart of some really common and frankly pretty dangerous misconceptions.
And the truth is, buying into these myths, well, it can be a very expensive mistake. So, in this explainer, we're going to break them down one by one. We're going to separate that fact from the fiction to get to the core of what this powerful strategy is really all about. Okay, let's dive right in.
So let's start with the big one, the most common and, the most tempting myth of them all. This is the one that really lures people in with that siren song of fast, easy money. The thinking kind of goes like this. You find a stock that the market has totally mispriced. You swoop in and buy it, and then, almost overnight, everybody else realizes their mistake. The price just skyrockets, you cash out, and boom, you're on your way. I mean, it is an incredibly appealing idea, isn't it? But it's also a fundamental misunderstanding of the entire philosophy.
The reality is just fundamentally different. It requires a huge mindset shift. Value investing isn't some quick sprint. It's a strategic marathon. You're not chasing those flashy, fast gains. You're methodically, carefully building lasting success. And it has almost nothing to do with trying to time the market's every little move, and everything to do with unwavering, disciplined patience. And look, here it is, straight from the father of value investing himself. Benjamin Graham knew that markets can be irrational, and sometimes they can stay that way for a long, long time. So patience isn't just a virtue here. It is a core, non-negotiable ingredient. The market can, and it often does, take its sweet time recognizing what a company is truly worth.
Okay, let's move on to our next myth. This one leads a lot of investors down a really risky path where they confuse a bargain price with a bargain investment. And believe me, they are not the same thing.
This is such a classic trap. It's so easy to see a stock that's just been beaten down. You look at that low price tag and you think, hey, this has got to be a value play. But a low price doesn't automatically mean a stock is undervalued. Sometimes a stock is cheap for a very, very good reason, because the company itself is in real systemic trouble.
And this table here, it just illustrates the difference perfectly. So while both a truly weak company and an undervalued gem might have a low price, that is exactly where the similarity ends. Just look at the fundamentals. Weak companies are poor or getting worse, while undervalued gems are strong, resilient. And that leads directly to the real key, the recovery potential. For one, it's low. For the other, it's high.
So you got to think of it like an iceberg. The price is just the tip that you see above the water. A true value investor is looking beneath the surface for these signs of real underlying strength. They're asking the hard questions like, is the management team here skilled and honest? Does the company have a durable competitive advantage, what some investors call a moat, that protects it? What's its actual market position? The price is really just the entry point for a much, much deeper investigation.
And all of that deep investigation, all that work, it perfectly illustrates why our next major misconception is so incredibly wrong. And that's the idea that in today's fast-paced, high-tech market, this old method is just too slow and passive to even work anymore.
The critics, they'll tell you the principles are old-fashioned, that it was fine for Benjamin Graham's era, but it just can't keep up today. They have this picture of a value investor buying a stock, sticking the certificate in a drawer somewhere, and just checking on it years later. And it's a total caricature, but it's a persistent one.
But this could not be further from the truth. Value investing is an incredibly active and disciplined process. Yeah, it starts with intense analysis, but it definitely doesn't end there. Holding a stock requires active patience, not passive neglect. And the really crucial parts that people often miss are numbers 4 and 5 here. You have to continuously evaluate your holdings and know when to sell, either because the market finally agrees with your valuation or, just as importantly, because the fundamentals have actually changed for the worse.
You know, this active approach isn't limited by company size either. There's this other little sub-myth that this is only for giant established companies, but that's not true. The same deep analysis can uncover these hidden gems in the small cap space, companies that larger firms and analysts might completely ignore, and that can offer some truly unique opportunities for growth.
Okay, so if it's not a get-rich-quick scheme, and it's not about buying failing companies, and it is certainly not a passive strategy, what is the real secret? What's the key to making value investing actually work?
It all comes down to this. Right here, it is not about some secret formula or a magic stock-picking algorithm you find online. It's about building a strong, personal foundation of knowledge that allows you to make smart, independent choices completely separate from all the noise and the hype of the crowd.
Graham's whole philosophy always circled back to this central idea. Education is the tool. It's the thing that gives you the confidence to trust your own analysis, not the market's daily, often frantic noise. It's what allows you to see what other people miss and to act with real conviction when they're paralyzed by fear or greed.
And when we say education, this is the kind of toolkit we're talking about. It means understanding the financial basics, so you can actually read a balance sheet, you know? It means grasping how markets behave and knowing their history. You have to learn solid risk management. And maybe the most important one of all, you have to learn how to spot your own emotional biases that can lead to some incredibly costly mistakes.
So, the crucial takeaway here, what we've really uncovered today is that this isn't about tricks or shortcuts. It's a disciplined mindset. It's a whole philosophy that's built on a foundation of hard work, emotional fortitude, and just an unwavering commitment to never, ever stop learning.
So we'll leave you with that question to think about, because after you've learned the fundamentals, after you've busted all the myths, you often find that the biggest challenge in investing, well, it isn't the market, it's managing our own psychology. Thanks for watching.
Welcome to The Explainer. You know, you hear about these legendary investors, guys like Benjamin Graham, and you have to wonder, how did they do it? How did they consistently find those winning stocks year after year? Well, I'll tell you, it wasn't magic. It was a methodical approach and a really well-stocked toolkit. Today, we're going to open up that very toolkit piece by piece and give you the essential resources you need to become a smart value investor. Okay, so here's how we're going to tackle this. We're going to build our understanding like a pyramid. We'll start at the bottom with the absolute bedrock of financial analysis. Then we'll add layers of key metrics and timeless wisdom. And finally, right at the top, we'll place the capstone, all the modern digital tools that kind of give us a bird's eye view of the whole landscape. So let's jump right in and get that foundation poured. So before we even lay a single brick, we've got to be crystal clear on the mission, right? We live in a world that is just drowning in financial noise. I mean, 24/7 news cycles, endless hot tips from so-called gurus. The true goal of a value investor, it's to tune all of that out and find that one clear signal of genuine underlying value. And it all really boils down to this fundamental principle from Benjamin Graham himself. Now, on the surface, it sounds incredibly simple, right? Just find good, solid businesses that the market is selling at a discount. But what does strong fundamentals actually mean? Well, it means a business that makes money consistently, doesn't have a mountain of debt, and has a real competitive edge. The real trick, and what we're going to get into, is figuring out how to spot when one of those great companies is truly on sale. And that's the big question, isn't it? It's the challenge we're here to solve today. With so much data and so many opinions flying around, finding real value can feel like trying to find a needle in a haystack, but it's not impossible. Not if you have a clear roadmap and the right set of tools, which is exactly what we're about to put together.
All right, we're at the base of our pyramid. For any investor, the ultimate foundation is a company's financial statements. I want you to think of them as a business's financial DNA. They hold the unique code, the secrets, really, to its health, its performance, and its future potential. Let's start cracking that code.
Okay, so you've got these three pillars, and let me be clear, they are absolutely non-negotiable. Without understanding these three documents, you're not investing, you're just gambling. They give us the raw, unbiased data we need to even begin to figure out what a company is truly worth.
First up, the income statement. You can think of it like a report card for the business over a certain amount of time, like a quarter or a year. It starts with all the money that came in the door, subtracts all the costs of doing business, and what's left over at the bottom, that's the final grade. It tells you in plain black and white whether the company is making money or losing it.
Next, we've got the balance sheet. Now, if the income statement is a video showing performance over time, the balance sheet is like a single crisp photograph. It's a snapshot of the company's financial health on one specific day. It lists everything the company owns, its assets, and balances that against everything it owes, its liabilities. What's left over is the company's net worth, also known as shareholder equity. And finally, the cash flow statement. And look, you could argue this is the most important of the three. Here's why. A company can show a huge profit on paper, but if it runs out of actual cash to pay its bills, it can still go bankrupt. It happens. This statement tracks the real, cold hard cash moving in and out of the business. It is the ultimate reality check. So, our foundation is in place. We've got the raw data from those three statements, but raw data on its own is, well, just a bunch of numbers. What does it all mean? That's where financial ratios come in. They're the tools we use to translate all those numbers into real, actionable insights. Let's start with an absolute classic, the price-to-earnings ratio, or PE ratio. The easiest way to think about it is like this. It's the price tag you're paying for a company's profits. So a PE of 10 means you're paying $10 for every $1 of that company's annual earnings. A low PE can be a sign of a bargain, but as we're about to see, it's not always that simple. Now, this slide is super important because it shows you that a low PE ratio can be a double-edged sword. On one hand, yeah, it might be a huge green flag pointing to an undiscovered gem, a solid company the market has just totally overlooked. But on the other hand, it could be a massive red flag, a warning that the market expects profits to fall off a cliff. And this is exactly why you can never, ever rely on just one single metric. Okay, another crucial tool, especially for checking risk, is the debt-to-equity ratio. This tells you how much a company is leaning on borrowed money to run its business. A low ratio is great. It means the company is funding itself and is on solid ground. But a high ratio? That can be a danger sign that the company is taking on too much risk, making it really vulnerable if the economy takes a downturn.
So now let's put it all together. This is where the picture really starts to come into focus. Take a look at Company A. It's got a low PE, so it looks cheap. Its price-to-book ratio is under 1, which means you might be buying its assets for less than they're worth. And look at that debt-to-equity. It's super low, plus a strong return on equity. Now compare that to Company B. It looks expensive, and it's loaded with debt. For a value investor, Company A is lighting up like a Christmas tree. We're moving up the pyramid now. You know, a great architect doesn't just know the math. They understand the timeless principles of what makes a building strong and beautiful. In the same way, a great investor doesn't just crunch numbers. They draw from this deep well of wisdom that's been built up over decades. And the Bible for any value investor, the absolute cornerstone of that library, is security analysis. Graham and Dodd really hammer home two huge ideas in this book. First, how to figure out a company's intrinsic value, what it's really worth, regardless of the stock price. And second, the critical importance of a margin of safety. And that just means you always pay a lot less than that intrinsic value to protect yourself from mistakes and just plain bad luck. And this is where things get really cool. We don't have to be stuck in the 1930s. We can take those timeless principles from Graham and supercharge them with modern research. We can take his ideas about being disciplined and avoiding emotion and back them up with modern studies on behavioral finance, which show us exactly how our own psychology can lead us into making bad decisions. It's about grounding that classic wisdom in today's data. You know, learning to invest isn't something you have to do locked away in a room by yourself. In fact, you shouldn't. Joining a community of other investors can be a total game changer. It's where you can kick ideas around, have someone point out a blind spot in your analysis, and learn from the mistakes and the big wins of others. It's an incredibly powerful way to sharpen your skills. And now we reach the top of our pyramid. We've got our foundation, we've got our analytical framework, and we've got our library of wisdom. It's time to put the capstone on, the digital tools that let us apply all this knowledge with amazing speed and efficiency. It's kind of wild when you think about it. The tools we have on our laptops today used to be things only the biggest Wall Street firms had access to. With just a few clicks, you can use a stock screener to find every company with a low PE and low debt. You can track your whole portfolio in real time. You have access to a treasure trove of financial data that would have taken Graham decades to collect by hand. So here's how you actually put this into practice. You use a screener to do the initial heavy lifting. You plug in your criteria based on all those value principles we've talked about. The tool then sifts through thousands of stocks and spits out a manageable list. But, and this is the most important part, the screener doesn't give you the answer. It's an accelerator. It finds the haystacks where the needles might be. It's still your job to roll up your sleeves and do the real analysis to find them. And so, here we are. We've reached the top. We've built our entire pyramid of knowledge, from that solid foundation of data all the way up to these sophisticated tools at the peak. But from up here, you realize something final and something really crucial. The work of a true value investor is never actually done. And this, right here, is what it all comes down to. The single most powerful tool in your entire toolkit isn't a specific ratio, it's not a book, and it's not a website. It's your unwavering commitment to never stop learning. In a world with too much information, the real competitive edge comes from constantly sharpening your mind, questioning your own beliefs, and adapting to a world that never, ever stops changing. Look, the world of investing is always evolving. The true key to long-term success isn't some secret formula. It's a commitment to learning with curiosity and with humility. You now have the blueprint, and you've got the tools. The only question left is, what value will you build?
You know, in the world of finance, there are some ideas that seem so simple on the surface, but are just incredibly difficult to get right in practice. Today, we're going to tackle the big one, value investing. We're going to dive deep into why it's so tough and what it really takes to master it.
So let's get right into the central puzzle here. The basic idea of value investing is, honestly, simple enough for a kid to understand. And yet, almost everyone who tries it fails. So the big question is why? Why is a strategy that makes perfect sense on paper so brutally hard to pull off in the real world?
And that's really the heart of it, isn't it? The whole game is about buying a dollar for 50 cents. It's the ultimate bargain hunt. But look, if it were that easy, we'd all be rich, right? So there's got to be a catch. We're going to peel back the layers and get into the real challenges that separate the pros from the rest of us.
Okay, so let's start by framing the problem. I like to call this the value investor's paradox. It's all about that giant chasm between knowing the right path and actually being able to walk it.
So what are we really talking about? Well, it all goes back to the legend himself, Benjamin Graham. And his entire philosophy boils down to one critical word, discipline. See, this isn't about guesswork. It's not about following the herd. It's about doing the hard, tedious work to figure out what a company is truly worth, its intrinsic value, and then having the patience of a saint to wait for the market to offer it to you at a discount.
And this slide just nails that core conflict. In theory, value investing is this calm, logical, long-term endeavor. But in practice, it's a bare-knuckled brawl against your own emotions and the relentless pressure from the market to get results right now. This is the gap where a simple concept becomes a massive challenge.
So where does all this difficulty come from? Well, the first major hurdle isn't sitting in your spreadsheets or your analysis. Nope, it's out there, in the wild, unpredictable, and often totally irrational stock market.
Now, this phrase, market inefficiency, might sound like a bad thing. But for a value investor, it's the whole reason to get out of bed in the morning. This is the entire game. It's the gap between price and actual value. If markets were perfectly efficient and every stock was always priced exactly right, value investing wouldn't even exist. There'd be no bargains to find.
So why are markets so inefficient? It's simple, really. They're run by us, by human beings. And our emotions, our fear, and our greed create these huge distortions in prices. We panic sell perfectly good companies, and we chase after speculative bubbles. And those emotional mistakes are exactly what creates the bargains that value investors are hunting for.
To make things even tougher, the market usually has a favorite child, and that's growth investing. It's the flashy, exciting philosophy that chases the hot new thing. Value investing, on the other hand, is the slow and steady marathon runner. It looks for solid, dependable, maybe even kind of boring companies that are being overlooked. And when the market's in a frenzy, boring rarely gets a lot of love.
And this is an absolutely crucial point. You can do all your homework. You can find a fantastic, undervalued company, and then you can watch it do absolutely nothing for years. It might even go down, all while the flashy growth stocks are soaring. This is where your conviction gets put to the ultimate test. It's a lonely road, and you have to have a deep, unwavering belief in your own analysis.
But as tough as the market is, it's not your biggest challenge. Not even close. The real battle, the main event, that's the one that's happening right between your own two ears.
Meet your own worst enemy. That's fear. The voice that tells you to sell a great company just because the price dipped, which is the very definition of selling low. Then you've got greed, whispering in your ear to dump your strategy and chase that hot stock everyone's talking about. These biases are hardwired into our brains, and they are the #1 saboteurs of any sound investment plan.
This quote just says it all, doesn't it? Your rational brain, your thinking brain, can build the perfect case for an investment. But the second that real money is on the line and the market starts to swing, your emotional brain can just hijack the whole operation and drive you straight into making impulsive, destructive decisions.
And to make it even harder, just look at the world we live in. Everything is about speed, instant gratification. The market itself screams at you to do something, to act now. But value investing demands the exact opposite. It demands inaction. It requires incredible patience to let your ideas play out over years, not days. And that friction between a patient strategy and an impatient world is a huge barrier for people.
Okay, so the market is irrational and our brains are basically wired to fail. Sounds pretty hopeless, right? Well, not at all. Now we get to the good part, how to build a defense. Let's talk about a modern strategy for success.
So here's a framework, a game plan. It starts with a timeless, rock-solid foundation of Graham's principles. Then we enhance that with modern tools.
We protect our whole strategy with a crucial guardrail. And finally, we maintain it all with the right mindset. Let's break these down.
Now, let's be very clear. Technology is not a substitute for thinking. It's a supercharger for your analysis. Think about it. AI can screen thousands of companies in seconds looking for the exact financial markers that Graham championed. It can do work that would have taken him weeks to do by hand. This lets you combine his timeless wisdom with some serious 21st century horsepower.
That really is the billion-dollar question, isn't it? You can have the best analysis in the world, but it's totally useless if you panic and sell at the first sign of trouble. So how do you put a leash on those destructive emotions?
This right here, this is your guardrail, an investment policy statement, or IPS. It's basically a document you write to yourself when you are calm and rational. You define your goals, your rules for buying and selling, your whole philosophy. It's a pre-commitment to acting logically. So when the market is crashing and you feel that fear bubbling up, you don't have to think. You just follow the plan your smarter self already made.
So, we've covered the market, we've covered the mind, we've talked strategy and tools, but all of this, every bit of it, comes down to one single overriding factor, the ultimate key to success.
And here it is. This is the absolute core of everything. With all the tools we have today, finding an undervalued company isn't actually the hardest part anymore. The truly, profoundly difficult part is buying it and then doing nothing. Just waiting. Waiting for the market to finally see the value you saw months or even years ago. It is a test of patience, pure and simple. So if you remember anything, remember this. The market is going to test you relentlessly. Your own mind will often be your biggest enemy in this fight. The only real defense you have is a disciplined strategy that you write down ahead of time. And ultimately, success in value investing isn't really a test of your IQ, it's a test of your character.
And that's the question I want to leave you with. Understanding the theory, well, that's the easy part. And now you do. But knowing what to do is a world away from having the personal fortitude to actually do it when things get tough. The strategy is simple, but the real question is, do you have the character to see it through?
You ever look at the stock market and just get overwhelmed? The constant noise, the wild swings, the so-called hot tips. It's a lot. It's easy to feel like you're just lost in the chaos. But what if there was a different way? A calmer, more rational approach to it all? Well, that's exactly what we're going to dig into today. The simple, powerful, and timeless principles of value investing. An idea that really got its start with the legend himself, Benjamin Graham.
So here's the game plan. First, we're going to break down Graham's core philosophy, the big ideas that are the foundation for everything else. Then, we'll look at what a big win really looks like, and just as important, what we can learn from a loss. We'll even take a peek into Graham's own playbook to see how he put his money where his mouth was. And finally, we'll pull it all into the 21st century and see how these ideas are more relevant than ever.
All right, let's kick things off with the Graham philosophy. And the best way to think about this isn't some super complex, high-tech trading strategy. Nope. It's more like a blueprint for building a financial fortress, something solid to protect your investments from all the madness out there.
And it all starts with this question right here. This gets to the absolute heart of Graham's entire worldview. He basically said, what if all that day-to-day chaos in the market, the stuff that scares most people, isn't a threat at all? What if it's actually a massive opportunity? For the investor who can stay disciplined, that chaos is exactly where you find the best deals. And this idea really rests on two key concepts.
Okay, concept number one, intrinsic value. Look, think of it like this. The stock price you see on the screen, that's just the price tag. The intrinsic value, though, is what the thing is actually worth. The entire job of a value investor is to completely ignore that flickering price tag and do the homework to figure out what the business behind it is truly worth. You know, its assets, how much it earns, its real potential. And that leads us straight to the second, and I'd argue the most important principle of all, the margin of safety. So let's say you do your research and you figure out a company is really worth $100 a share. You don't buy it at 99, you wait. You wait until the market has a panic attack and offers it to you for, say, 60 bucks. That $40 difference, that is your margin of safety. It's your cushion. It's your buffer in case you're wrong, or for bad luck, or for anything else you can't see coming. It is the ultimate defense.
Okay, so we've got the core ideas down. But what does it actually look like when it all comes together? Let's take apart a win, piece by piece, and see why discipline and patience are the real secret ingredients here. This slide just nails the two completely different mindsets. Over on one side, you've got market fads. That's the emotional roller coaster, chasing hype, following the herd, all driven by excitement. And then you've got the value investor. They're calm, analytical, focused only on the real long-term potential of the business, and they are perfectly happy to be the one person standing apart from the crowd.
And make no mistake, this isn't about having a gut feeling. It's a clear, methodical process. It starts with deep analysis. You gotta do the homework. Then you find that gap between the market's price and the company's real value. But honestly, step 3 is the one that gets almost everybody. Patience. You can find a fantastic company, but you might have to sit on your hands for months, maybe even years, waiting for the price to get cheap enough. But when it does, you jump on it because you know your margin of safety is huge.
And that's really what this whole thing is about. Everyone else sees the noise, the chaos, the confusion. The special skill of the value investor is to look right through all of that and spot the real, durable value that's hiding in plain sight.
But let's be real for a minute. Nobody wins every time. Not every investment is a home run. And that brings us to something that's absolutely crucial, learning from your losses. Because this is where the spreadsheets and the analysis stop, and your own psychology starts to take over. It's all about emotional discipline.
This quote pretty much says it all. Graham taught that the biggest risk to your financial future isn't a bad economy or a market crash, it's you. It's your own emotional reaction to things. The second you let fear or greed take the wheel, you've thrown the whole strategy right out the window.
And these right here are the classic traps people fall into time and time again. Chasing whatever's hot, doing what everyone else is doing, letting panic or excitement make your decisions. You notice the common thread here? Every one of these mistakes comes from forgetting that one core idea, your margin of safety. It's the root of almost every bad investment story.
But here's the mindset you have to adopt. A loss isn't a failure, it's tuition. Yeah, it can be really expensive tuition, but it's a powerful lesson. It forces you to go back to the drawing board and figure out what you got wrong. And every mistake, if you actually study it, makes you a much sharper investor next time around.
So you might be asking, did Graham actually do all this stuff himself? Oh yeah, absolutely. Let's pull back the curtain a little and take a look at the Master's Own playbook.
You can see his entire philosophy right here in these 3 actions. His version of risk control wasn't about guessing. It was about meticulously grinding through financial statements. His idea of patience wasn't waiting a few weeks. He was thinking in terms of entire economic cycles. And doing those 2 things allowed him to be a true contrarian, to calmly buy when everyone else was selling in a panic.
This is the mental flip that changes everything. When the average person sees a market crash and feels nothing but fear, Graham saw a clearance sale. He knew that widespread panic was his best friend because that's when fantastic businesses get put on the discount rack.
You know, his whole strategy was built on this one simple, timeless truth about people, that our collective emotions, our fear, and our greed will always cause the market to make mistakes and get prices wrong. And for the investor who can stay rational, those mistakes aren't problems. They're the very opportunities you've been waiting for.
So that brings us to the big question, right? How does all this thinking, which was born in a totally different era, actually hold up in the super fast, high-tech market we have today? Well, let's dive into our last section and meet the modern value investor.
The foundation, it is exactly the same. The core idea is and always will be timeless. Try to buy $1 for 50 cents.
But the way we build on that foundation has definitely evolved. Today, we can apply those exact same principles, but with incredible modern tools, way more access to data, and all the wisdom we've gained from the great investors who came after Graham.
And this slide right here shows the biggest evolution of all, perfectly. See, Graham was a pure numbers guy. He was famous for hunting for what he called cigar butt stocks, basically cheap, ugly companies that had one last good puff of value left in them. But his successors, guys like Charlie Munger, they added this brilliant new layer. They asked, what about the quality of the business? They argued that it's way better to buy a wonderful company at a fair price than a mediocre company at a bargain price. And when you fuse those 2 ideas together, the result is just incredibly powerful. You get Graham's discipline about the price combined with a deep focus on the quality of the business itself. The goal is a strategy that can improve your long-term returns while, and this is key, adding another powerful layer of defense against losing your shirt.
So if you only remember a few things from our talk today, let it be these. First, this is a real strategy, based on analysis, not just a gamble. You have to learn to separate a stock's price from its real underlying value. Your margin of safety is your best friend. It is your #1 defense against risk. And never, ever forget
that controlling your own emotions is just as important as all the financial analysis in the world. These principles aren't rigid rules. They're a timeless mindset you can adapt for any market.
So I'll leave you with this one last thought to chew on. In a world that's run by AI, by algorithms, and instant news, is it possible that the last great competitive edge an investor can have isn't a faster computer, but simply the old-fashioned human discipline to be patient and to be rational when everyone else is losing their minds? Something to think about. Thanks for joining me for this explainer.
Welcome to The Explainer. Today, we're diving into something I find absolutely fascinating. What happens when a classic, time-tested investing philosophy slams into the high-speed world of artificial intelligence? Can the old wisdom of value investing, the slow and steady approach, even survive in the age of algorithms? Let's find out.
Okay, let's just get right to it because this is the billion-dollar question, isn't it? I mean, when a machine can sift through millions of data points in the blink of an eye, does the old-school, patient approach of digging for hidden value even have a prayer? It's a fair question, and we're going to tackle it head-on.
So, here's our game plan. First, we're going to go back to basics and look at the ideas of the master himself, Benjamin Graham. Then, we'll see how those ideas are faring in today's crazy market. After that, we'll get into the big one, technology, and how it's both a blessing and a curse. And finally, we'll look into the crystal ball and see what the future might hold for value investing.
All right, let's start at the beginning, because to really wrap our heads around this, we have to understand the foundational principles from the guy who literally wrote the book on it, Benjamin Graham, the father of value investing.
The core idea is just brilliantly simple, but it's so powerful. Forget the hype, forget what's trending on Twitter. The goal is to buy a solid business for less than it's actually worth. It's really that simple. It's like finding a dollar bill on sale for 50 cents. Who wouldn't take that deal?
And these tenets, they're not just random tips. They create a whole framework for rational investing. It's not about being a math genius. It's about discipline. It's about seeing a stock for what it is, a piece of a real business, not just a ticker symbol on a screen. And maybe the most important part, keeping your emotions in check so that fear and greed don't lead you off a cliff.
And here's the kicker. It worked. This wasn't some abstract theory cooked up in a university. Graham's careful, methodical approach delivered real, significant gains. It's all the proof you need that a strategy built on deep analysis and emotional discipline can actually lead to real success.
So, that was then. How do these classic principles hold up in the here and now? Let's take a look at how they're being tested by new markets, new priorities, and totally new ways of thinking about what makes a company valuable.
So, it's really crucial to understand this fundamental split in philosophy. Value investing, the Graham way, is all about what a company is today, its real assets, its current earnings. Growth investing, on the other hand, is about what a company could be tomorrow. They're two totally different mindsets, and investors have been arguing for decades about which one is better.
And the evidence for value investing isn't just found on Wall Street. Let's look at this really fascinating study from the Nairobi Securities Exchange in Kenya, which put these exact principles to the test in a completely different environment.
And the results were pretty stunning. Even in an emerging market, Graham's principles held true. The stocks that were undervalued based on their fundamentals, things like the price-to-book ratio, consistently did better than the more exciting, high-growth stocks. Now think about what that means. It suggests that the basic human instinct to find a bargain, to buy something for less than it's worth, is a universal driver of the market. This isn't just a Western idea, it's a fundamental principle of investing.
But today, the idea of value itself is getting bigger. It's not just about the numbers on a balance sheet anymore. Investors are starting to ask some deeper questions about the character and the impact of the companies they own.
And this is a total game changer. It's called ESG investing, and it adds this whole new layer to the analysis. For the E, environmental, we're asking, what's this company's carbon footprint? For S, social, we're asking, how does it treat its workers in its community? And for G, governance, we're asking, is the leadership team accountable and transparent? These are the kinds of questions that are totally redefining what a quality, sustainable business looks like in our modern world.
All right, now let's talk about the big one, the great disruptor, the thing that changes everything, technology. For the value investor, it brings both incredible new powers and some really dangerous new temptations. It is a classic double-edged sword.
So on one hand, the power is just staggering. I mean, AI and machine learning can chew through mountains of data, financial reports, news articles, you name it, to find undervalued stocks, faster and more accurately than any person ever could. It's like giving Benjamin Graham a supercomputer.
But here's the other side of that coin. The same technology that gives us all that data also pours gasoline on our emotions. Think about it. Social media, select trading apps, the 24/7 news cycle, they can whip up a speculative frenzy in minutes. This is the exact kind of herd behavior that Graham warned us about his entire life.
So this is the tightrope every modern investor has to walk, right? How do you harness all this incredible technological power to make smarter, more rational decisions while at the same time avoiding all the emotional traps it sets for us?
And this quote just nails it. At the end of the day, it all comes back to discipline. The technology is new, but our human psychology, that's ancient. In a world that's drowning in information, some of it good, a lot of it bad, the ability to just slow down and think clearly, well, that's a genuine superpower.
So, where does that leave us? What does the future actually hold? Is this some kind of battle between Graham's old-school wisdom and today's new-school tech? I don't think so. The answer isn't about choosing one over the other. It's about a powerful combination of the two.
We're definitely moving toward a hybrid model. The future of successful investing isn't about throwing out Graham's principles. No way. It's about making them even better by using today's incredible tools to apply those timeless ideas more effectively than ever before.
And this right here is the key takeaway. It's a practical roadmap for how to invest in this new era. You start with that solid Graham foundation of business analysis. Then you enhance it with technology, using AI as a tool, not a crutch. You broaden your definition of value to include those modern ESG factors. And through it all, you maintain that ironclad emotional discipline to cut through all the noise.
And that's really the thought I want to leave you with. This debate isn't about man versus machine, or old versus new. The real opportunity, the real magic, is in the combination. The most successful investors of the next generation are going to be the ones who can stand on the shoulders of a giant like Graham while using the most powerful tools of today to see even further into the future.
You know, in today's financial world, it's so easy to get completely lost in the noise, right? But what if I told you there was a proven compass, a guide to get you through all the chaos? Well, today, that's exactly what we're going to dig into, the powerful, enduring philosophy of value investing. I mean, does the market these days just have your head spinning? If it does, believe me, you are not alone. We're all trying to figure out this wild landscape of super low interest rates, nagging inflation fears, and all these new factors like ESG criteria that are totally changing the game. It can feel like absolute chaos. But thankfully, there's a framework designed to bring some much-needed clarity to all that confusion. So here's our game plan for today. We're going to start with what I call investing's timeless compass. Then we'll break down the 3 pillars of value. After that, we'll talk about surviving the roller coaster of market psychology. We'll see how value investing fits into today's world. And finally, we'll lay out your path to mastering this whole thing.
All right, let's jump right into part 1, investing's timeless compass. Think of this as your guide through all the market chaos.
Look, it doesn't matter what the latest trend is or what the talking heads on TV are panicking about. Real long-term success comes from having a consistent, logical plan. And the man who really pioneered this whole philosophy was the one and only Benjamin Graham. He believed that if you have the right framework, any investor, and I mean any investor, could make sound choices really by taking advantage of the market's own irrationality. And this quote from Graham really gets to the heart of it. His core belief was that investing isn't about getting lucky. It's not about hot tips, and it's definitely not about trying to time the market. No, it's about knowledge and it's about hard work. It's about rolling up your sleeves and doing the research to understand what a company is truly worth, completely separate from its buzzy day-to-day price tag. Okay, on to part 2, the 3 pillars of value. These are the absolute foundational principles of Graham's entire philosophy. So the first pillar, and this is really the bedrock of the whole thing, is intrinsic value. This just means you're not looking at a stock's price on the screen. Not at all. You're acting more like a detective, right? You're digging deep into a company's financial health, its earnings, its dividends, its balance sheet, to figure out what it is genuinely actually worth. Now, the second pillar is your ultimate defense. It's called the margin of safety. So once you've done your homework and calculated that intrinsic value, you only pull the trigger and buy the stock if it's selling for substantially less. This simple rule creates a buffer, a cushion, that protects you from bad luck, from scary market downturns, and hey, even from your own mistakes in your calculations. It happens. Let's make this totally crystal clear. Imagine you've done all your research, and you've determined that a company's stock is truly worth $50 a share. But the market, in a moment of total pessimism, is selling it for just $35. Well, that $15 difference, that's your margin of safety. That is your cushion, your built-in protection against all the crazy stuff you just can't predict.
And the third pillar, well, this is a really critical distinction in your mindset. An investor, in Graham's world, is laser-focused on that intrinsic value we talked about. They're playing the long game. A speculator, on the other hand, is basically just betting on price movements and what the crowd is thinking, hoping for a quick buck. One is a disciplined, business-like operation. The other, well, it's just a gamble.
All right, part 3, surviving market psychology. This is huge. Let's look at how these pillars actually become your shield against fear and greed.
See, by anchoring every single one of your decisions to intrinsic value and that margin of safety, you're building a powerful psychological shield. It stops you from making emotional decisions just because of a scary headline. It helps you resist following the herd into the latest frenzy, and crucially, it builds the resilience you need to avoid panic selling when the market takes a dive. At the end of the day, it just fosters a patient, disciplined mindset.
Really, what it comes down to is this. Graham's whole system is a counterweight to the madness of the crowd. When other people are freaking out and selling everything, your focus on the fundamentals helps you spot an incredible bargain. And when everyone else is greedy and prices are shooting to the moon, your discipline tells you, hey, maybe it's time to just wait. You learn to develop a contrarian view that's grounded in cold, hard logic, not emotion. So that brings us to part 4, value investing today. I mean, does this old philosophy really hold up in our crazy modern world? Let's take a look at why it's probably more relevant than ever.
Let's just tackle some of these modern challenges head on. You're worried about low interest rates or inflation eating away at your returns? Okay, Graham's solution is to focus on a company's real, fundamental earning power. What about the rise of ESG? You adapt your analysis, you include it, but you never, ever abandon disciplined valuation. And for the constant market volatility and disruption, you guessed it, you lean hard on your margin of safety and you practice long-term patience.
And this brings up an absolutely crucial point. Value investing isn't some rigid, dogmatic formula. It can't be. It's a framework that demands a flexible yet deeply principled approach. You have to adapt to new technologies and new economic realities, for sure, but you never, ever abandon the core principles of doing your homework and making a disciplined choice.
So, the big question is, where do you go from here? In our final section, let's talk about your path to mastery. And spoiler alert, it's a continuous journey, not some final destination.
I want to leave you with 4 practical habits that you can start to cultivate. Number 1, commit to being a lifelong learner. You have to read, you have to study, and you have to stay curious. Second, develop the discipline to do the hard analytical work, even when it feels tedious. Third, don't just study balance sheets, study human behavior and market psychology. And finally, practice unwavering patience. The really great results, they often take a long time to show up. You see, at the end of the day, true mastery in investing isn't some secret code that only a few people have cracked. It's an achievable goal for literally anyone who's willing to dedicate themselves to the process, to education, to diligent effort, and to constantly, always improving their own methods.
So I'll leave you with this final thought. Every single day, the market just bombards us with an incredible amount of noise. Predictions, hot takes, panic, hype. It's endless. But the principles of value investing, they offer a clear, rational signal that can cut right through all of that chaos. The only question left is, what will you choose to listen to?